objection, the chair is authorized to declare a recess of the committee at any time. Today's hearing is entitled The Future of Deposit Insurance, Exploring the Coverage, Costs, and Depositor Confidence. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I now recognize myself for a 4-minute opening statement. Today's hearing will examine the deposit insurance framework in the United States, potential reforms that have been proposed, and key questions for policymakers to consider. Like the Senate Banking Committee, the House Financial Services Committee has been and will continue to be taking an approach that is thoughtful, deliberative, and data-driven. As we'll hear from our expert witnesses today, there's a wide-ranging set of views on this matter with no consensus. When it comes to deposit insurance reforms, there are no easy answers, and choices always come with trade-offs. That's why several discussion drafts have been noticed to the hearing today, so that members can appreciate just how many ideas are out there. A discussion about deposit insurance cannot be complete unless we also talk about the much-needed improvements to the bank resolution framework, which were laid bare by the bank failures that we saw during the spring of 2023 and made worse by actions taken then by the Biden administration. Let's be clear, deposit insurance was not the cause of those bank failures. They were the result of poor risk management by certain regional banks and the failure of federal and state supervisors to identify, fix problems that had already been focused upon by the examiner force. No level of deposit insurance would have made up for the erosion of the failed banks' identified deficient management decisions and the resulting impact on capital. The banks were insolvent, and increased deposit insurance wouldn't have fixed that. That's why legislation addressing the policy ideas like the least cost resolution mandate and the national concentration limits must be part of the conversation if we're going to take a comprehensive look at deposit insurance and prevent the 2023 bank failure type scenario from happening again. Going back to its creation during the Great Depression, the FDIC's Deposit Insurance Fund was intended to stabilize the banking system and now insures up to $250,000 per account. Currently, less than 1% of deposit accounts have balances above this level. The purpose of deposit insurance was twofold: to protect average Americans and to prevent destabilizing bank runs from occurring. This new framework carried a presumption that large depositors, such as corporations and wealthy individuals, had the capacity and resources to properly assess their bank's health, to diversify their deposit holdings, to secure their deposits, or to buy additional insurance on the private market. As we consider any potential changes to the deposit insurance framework, I believe our work must be informed by answering some key questions. What is the problem that we're trying to solve? Who will benefit? What are the costs and who will pay them? What are the potential unintended consequences? Do we have the data to make an informed decision? And if not, what are the gaps? Our guiding principle should be to ensure the stability of the banking system, maintain depositor confidence, fairly apportion costs, enforce market discipline, and reduce moral hazard. With that, I thank our witnesses for being with us today. I'm grateful for our colleagues' attendance, and I yield back the balance of my time. And now I recognize the ranking member of our full committee, Mrs. Waters, for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman. Good morning. Thank you to our witnesses for being here today to discuss deposit insurance. I wish we could have held this hearing a lot sooner, but Speaker Johnson shut down the House for 2 months, and the Trump Republican shutdown rendered the government lifeless for 43 days, surpassing the record set during Trump's first term. And for what? All to avoid lowering health costs for working class Americans. Now, during the shutdown, I visited food banks all across Los Angeles County and saw lines of families who were being used as political leverage, afraid their babies might starve as Trump fought twice in the Supreme Court to block their food stamp benefits. I heard federal employees agonize over how to keep a roof over their heads after missed paychecks. I heard the worries of furloughed workers wondering if they'd even get paid after the shutdown following Trump's threats. Meanwhile, millions of families are now watching their health care premiums triple. Then they turn on the TV to see the president offering a $40 billion bailout to Argentina and demolishing the East Wing of the White House to build a $250 million ballroom, all while Republican members of Congress enjoyed our paid vacation and remained deafening silence. At the same time, the administration moved to gut the Consumer Financial Protection Bureau, the Bipartisan Community Development Financial Institutions Fund, which will make life even more expensive for families and small businesses. Thanks to Trump and Republicans, Americans are suffering through an affordability crisis with little hope in sight. Trump's response has been to dismiss Americans' concerns as a, quote, con, quote unquote. Well, it takes one to know one. The American people see through Trump's con of giving handouts and favors for the super rich while raising prices on everyday Americans. It's why more than half of Americans are unhappy with the direction of the economy under Republicans and blame Trump for the high cost. Now, on deposit insurance. Since the fall of Silicon Valley Bank in 2023, I've led the effort to advance reasonable solutions to support our community banks and credit unions while protecting small businesses so they can bank with their local lenders and pay their workers even in a crisis. I'm pleased the chairman has convened this hearing and posted my legislation. Thank you, Mr. Chairman. The legislation, the Employee Paycheck and Small Business Protection Act, quote unquote. My bill takes a data-driven approach to increase the deposit insurance limit for business payment accounts. While the FDIC and NCUA study, my bill also allows regulators to quickly establish a transaction account guarantee program to prevent contagion and temporarily protect depositors for up to 9 months in a future emergency. Even Treasury Secretary Bissett and Vice President Vance agree that action on deposit insurance reform is overdue. While reviewing the Republican proposals, I'm hopeful that the chairman will work with me and all of our colleagues so we can get something done. I think we can have bipartisan on this one, Mr. Chairman. So I look forward to testimony, and I yield back.
Gentlewoman yields back. Now recognize the chair of our Subcommittee on Financial Institutions, Mr. Barr of Kentucky, for a 1-minute opening statement.
Following the banking instability of 2023, there were calls to reform deposit insurance. Members on this committee did not rush to enact legislation that might have resulted in unintended consequences, but rather took the time to examine potential reforms. And today's hearing is a result of this education. Properly calibrated deposit insurance is paramount to protect taxpayers and the stability of our banking system. Changes in the banking landscape, such as online banking, can create real-time risks, and an increase in uninsured deposits has posed questions about the current status quo. As we consider any potential deposit insurance reforms, our goal should be to protect the diversity of our banking system: community banks, mid-sized banks, regional banks, GSIBs. That is our competitive advantage. We must also consider the potential for moral hazard, how reforms will impact the smallest financial institutions' assessments. Public trust in our banking system through FDIC insurance cannot be lost. It is our job as members of Congress to protect this trust, taxpayers, and the diversity and stability of the banking system. I look forward to examining the deposit insurance landscape in today's hearing.
Gentleman yields back. I recognize the ranking member from the Subcommittee on Financial Institutions, Dr. Foster of Illinois, for a 1-minute opening statement.
Thank you, Chairman Hill and Ranking Member Waters. Deposit insurance has been one of the real triumphs of financial regulation of the last 100 years. Prior to the FDIC's creation, there was a steady drumbeat of banking failures, and people simply didn't know that their money would be safe in a bank. After that, every depositor of a U.S. bank or credit union knows that their financial institution, if it ever gets in trouble, the deposits less than $250,000 will be protected. And this is essential to stopping the contagion, which was the true systemic risk of the events of 2023. However, social media, technology, and consumer behaviors have evolved a lot since 2008, and the events of 2023 were a warning that technology-driven bank runs of today can be much larger and faster. And this committee, I agree, should take a data-driven approach to deposit insurance reform with a full understanding of the cost and benefits of the reform. So I thank the chairman for noticing this hearing and look forward to the witness's testimony.
Gentleman yields back. Today, we are delighted to have the testimony of Mr. James Ryan, Chairman and CEO of Old National Bancorp, Ms. Jill Castilla, President and CEO of the Citizens Bank of Edmond, Oklahoma, Mr. Chris Furlow, the President and CEO of the Texas Bankers Association, Mr. Grover Norquist, Founder and President of Americans for Tax Reform, and Mr. Jarryd Anderson, Partner and Co-Chair of the Financial Services Group at Paul Weiss. We're delighted to have you. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written statements will be made a part of the record. Mr. Ryan, we're going to start with you. You're recognized for 5 minutes.
Chairman Hill, ranking member Waters, and members of the committee. Thank you for the opportunity to testify. I'm Jim Ryan, Chairman and CEO of Old National Bank in Evansville, Indiana-based institution with $71 billion in assets and more than 350 locations across the Midwest. I'm proud to say Old National has been serving clients and strengthening communities since 1834. I'm also pleased to serve as a board member of the Mid-Sized Bank Coalition of America and as vice chair of the American Bankers Association, but I'm here today representing Old National Bank, and I think my views are consistent with other mid-sized bank CEOs. America's banking system is strongest when it includes large national banks, mid-sized banks like Old National, and smaller community banks. This diversity creates resilience and ensures that all communities enjoy access to financial services. Since the 2008 financial crisis, large banks have grown significantly. Yet the reality is they do not serve all communities or all businesses. Meanwhile, the number of smaller banks continue to decline. To support a healthy economy and vibrant communities, we need banks of all sizes working together. As I mentioned, Old National has been in operations for nearly 200 years, serving clients and communities that our nation's largest banks sometimes overlook. Like all mid-sized and community banks, our ability to keep credit flowing locally depends on confidence in deposits. And today's FDIC insurance limit of $250,000, unchanged since 2008, has not kept pace with the growth of the economy and the speed of money and information. We live in a world where money and information move at digital speed. As a result, liquidity stress can unfold at digital speed as well. We saw this in March of 2023. Deposits left mid-sized and community banks, while the largest banks reported tens of billions of dollars of inflows without raising rates. Uninsured business operating accounts drove deposit flight to the largest banks, not because of price, but because of the perception of safety. That inequity undermines trust, concentrates risk, and drains funding from the banks that finance Main Street. A solution such as the Main Street Depositor Protection Act, introduced by Senators Hagerty and Alsobrooks, is narrow by design, targeting FDIC coverage for non-interest-bearing accounts used for payroll, payables, and working capital. As you know, moral hazard arises when insurance encourages risk-taking or yield-chasing. That does not exist with non-interest-bearing operating accounts. These balances are not attracted by offering higher returns. They exist only to fund payroll and daily operations. This reform is about protecting paychecks and critical payment systems, not shielding banks. We're not talking about ensuring speculative investments or personal wealth accounts. We're talking about the operating cash that keeps employees paid. This gives Main Street businesses the confidence to maintain their existing deposit relationships with banks and bankers who truly know them and their businesses. This reduces systemic risk, lowers the threat of widespread deposit flight, and preserves local lending capacity. This reform is also industry-funded through risk-based assessments, no taxpayer appropriations. Some have charged that deposit insurance modernization will entail significant costs to institutions. However, the greatest costs come from inaction. Higher wholesale borrowing, repeated emergency measures, and lost long-time relationships. The estimated cost of deposit insurance reform is somewhere between 2 to 5 basis points. This modest risk-based premium is substantially lower than the 25 to 50 basis points typically incurred through wholesale funding or emergency borrowing. The Federal Reserve's analysis confirms that in 2023, banks experiencing deposit outflows were forced to replace lost deposits with higher cost borrowing, underscoring the reform's cost effectiveness. Our nation's mid-sized and community banks are the connective tissue between local deposits and local lending. When operating cash feels safe and secure at hometown banks, we can keep doing what we do best, turning deposits into loans for equipment, working capital, and expansion, along with reinvesting in and driving economic growth within our communities. The Main Street Depositor Protection Act is not about bailouts or special favors. It's about modernizing insurance for accounts that keep Main Street America thriving, so that confidence holds, paychecks clear, and our nation's banking system stays diverse and resilient. I urge Congress to enact targeted deposit insurance reform for business operating accounts. Modernizing insurance for these accounts is the most straightforward way to reduce risk, keep capital in our local communities, and fortify America's strong and diversified banking system. Thank you for the opportunity to testify. I look forward to your questions.
Thank you, Mr. Ryan. Ms. Castilla, you're now recognized for 5 minutes for your oral remarks.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify. My name is Jill Castilla, Chairman, President, and CEO of Citizens Bank of Edmond in Oklahoma. I founded Roger, a digital military bank based on my experience as a prior service member, military spouse, and parent of 2 current service members. I also previously served on the Federal Reserve's Federal Advisory Council during 2022 to 2024, a period of severe market stress, which informs my perspective today. Citizens Bank of Edmond is recognized nationally as one of the most innovative, resilient community banks in the United States. We operate a single location with about $400 million in assets. We compete and win against institutions many times our size. We are one of only 15 women-owned banks in the country. My message is simple. The 2023 turmoil was a crisis of confidence, not a crisis of coverage. The failures of Silicon Valley Bank, Signature, and First Republic stemmed from concentrated uninsured deposits, poor liquidity and interest rate risk management, and a breakdown in communication with customers, not from FDIC limits. Customers left these banks because trust failed. Community banks that engaged transparently kept deposits stable. Any policy decisions aimed at reforming deposit insurance coverage must take a holistic approach and not provide a gift to large regional banks. During the 2023 turmoil, following widespread news coverage of the impending collapse of Silicon Valley Bank, we called our customers before they called us. Within hours, we reached every depositor with uninsured balances and explained precisely how existing tools, reciprocal deposits, Federal Home Loan Bank letters of credits, and collateralization could fully protect their funds. We publicly shared our uninsured deposit ratio, liquidity, and capital strength, and invited direct contact with me. Customers stayed, and many brought new deposits because facts and transparency build and sustain confidence. Deposit insurance as designed works. For 90 years, no depositor has lost a penny of insured funds. The $250,000 limit already covers 99% of accounts, and my bank has roughly 90% of deposit balances fully insured. For larger needs, market tools extend protection without burdening the FDIC or taxpayers. Dramatically expanding coverage would create moral hazard, weaken market discipline, and distort competition. It would primarily benefit a small set of large regional and national institutions that hold the most uninsured balances, entrenching their advantages while spreading replenishment costs across the entire industry, including thousands of smaller, well-managed banks. Claims that such expansion targets small business are overstated. True small businesses already achieve full protection through existing limits and reciprocal networks. Infusing government-subsidized liquidity into regional banks and large credit unions could further accelerate industry consolidation of community banks. Expanded coverage would also invite gaming, shifting balances among account types or compensating depositors through side arrangements to qualify for guarantees, further eroding fairness and discipline. The cost of expanded coverage and its unintended consequences must be fully explored. There seems to be an imbalance of limited benefits with extreme cost exposure in nearly all avenues considered. By contrast, the current suite of market tools is effective and regulated. Collateralization, Federal Home Loan Bank letters of credit, and reciprocal deposits deliver full protection, same-day liquidity, and transparency, while embedding guardrails that limit access by troubled institutions, aligning safety with accountability rather than socializing risk. These approaches strengthen relationships and keep deposits local without expanding federal guarantees. Frankly, there are so many ways that we can help community banks, including enacting many of the bills that have passed in this committee, rather than arbitrarily raising the deposit insurance limit. Real reform must focus on clarity, proportionality, and data-driven oversight that reflects how community banks operate. Tailored regulation and capital would improve safety and fairness without inflating guarantees. Any proposal to alter coverage must be accompanied by honest, transparent analyses of costs, beneficiaries, and risk. Bottom line, stability comes from responsibility, not blanket guarantees. Expanding deposit insurance to cover multi-million-dollar accounts is a shortcut that creates moral hazard, rewards the largest beneficiaries, and penalizes the institutions that do things right. Confidence is built by communication, competence, and integrity. The strengths community banks demonstrated in 2023 and every day on Main Street. Thank you. I look forward to your questions.
Gentleman yields back. Mr. Furlow, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for the invitation to testify on behalf of the Texas Bankers Association and the proposed two-step deposit insurance strategy. We appreciate that there are a number of deposit insurance reform proposals before Congress, including the Ranking Member's bill, and on the Senate side, the bill by Senators Hagerty and Alsobrooks. We are not here today to oppose those bills, but to provide immediate protection of the banking system while allowing time to appropriately collect missing data and to evaluate the best approach to achieve overdue and permanent modernization. The risk and competitive structure of today's marketplace is dramatically different than it was when FDIC was created in 1933. Yet the objective of providing depositor confidence remains critical. Looking back to 2023, the social media-driven SVB bank failure nearly brought the banking system to its knees over a nerve-wracking weekend. It was quickly followed by the failure of Signature Bank. Yet across America, community and regional banks, through no fault of their own, were suddenly at risk from a deposit insurance system not up to the task. Depositors moved large sums of capital to institutions believed to be too big to fail, to government money market funds, and to other perceived safe havens. It was destabilizing, and regulators scrambled to put facilities in place before the markets opened on Monday. Simply put, we got lucky. Current systemic risk processes are antiquated and vulnerable to contagion that can now run at digital speed and within a 24-hour news cycle. Deposit insurance must help prevent systemic risk first, rather than first arguing over who pays when the system fails to stop it. With no firm consensus within industry or Congress, we strongly support a multi-stakeholder two-step process to provide immediate system protection while enabling data-driven and long-term reforms. The two-step plan is not just supported by the Texas Bankers Association. It is a collaborative approach backed by the Arkansas bankers, Colorado bankers, Kentucky bankers, Missouri bankers, Oklahoma and New Hampshire bankers. Together, these associations from Middle and Main Street America represent over 1,000 banks, nearly 1/4 of FDIC-insured institutions. Our first step, an emergency transaction account guarantee or ETAG capability. Deposit insurance must be a prophylaxis against bank runs, not a reactionary facility. With the confidence it can provide, impacts to the deposit insurance fund can be prevented in the first place, which helps avoid expensive and always contentious assessments. Our ETAG proposal would ensure that in a systemic emergency, depositors at banks of all sizes are protected, not just those at institutions deemed too big to fail. Our approach was designed to address the 2023 shortfalls that put the system on edge. This includes stopping contagion. The ETAG proposal provides a 120-day period in which there is full coverage of transaction accounts at banks of all sizes, not just the largest. This will preserve confidence, as the 120-day period allows precipitating conditions to subside. The 120-day period also allows collection of a full post-event quarter of data to inform forward-looking decision-making by Congress, the administration, and regulators. Bureaucratic delay. In the digital social media age, our proposal would replace Fed FDIC processes that are far too bureaucratic when time is of the essence and depositor confidence is at most risk. With notice to the FDIC and Fed, our proposal enables the Treasury Secretary to invoke systemic risk authority to quickly implement the ETAG program without delays. Moral hazard. The 120-day period is for systemic emergencies and is by design temporary to avoid concerns related to moral hazard. And there are checks and balances in our ETAG proposal, as any extension beyond 120 days would require congressional approval. The ETAG approach will ensure that the system helps prevent bank runs, in contrast to 2023, when uncertainty caused too many community and mid-sized banks to experience deposit flight. Moreover, this proposal is fair across bank sizes and across all depositors. It does not pick winners and losers. Members, we've sustained 2 systemic emergencies in the last 5 years. This proactive program is system preparedness. The mere fact FDIC would have this tool will promote long-term confidence for depositors, investors, and the markets. With a tag backstop in place, we can then move to accomplish the second, more complex and politically sensitive step, to fully and fairly modernize deposit insurance. As you will see in my full statement, there's a list of important questions that remain unanswered beyond simply addressing assessment thresholds to include fixing the bank resolution process. One final comment. Banks pay deposit insurance premiums. It is not a bailout. But in 2023, our community, mid-sized, and regional banks were stiffed when the government could not say if it would follow through to protect those that had paid deposit insurance premiums. That's unacceptable. Ultimately, we ask Congress to reconsider what constitutes a systemically important bank. All banks, to include small, rural, urban community banks, and the mid-sized banks that work with them, are systemically important to the communities they serve. Mr. Chairman, thank you for the thoughtful examination of this critical issue. We look forward to working with you to protect the system today and to comprehensively modernize deposit insurance for the future.
Thank you very much. Mr. Norquist, you're recognized for 5 minutes.
Yes, Chairman Hill, Ranking Member Waters, members of the committee, thank you for inviting me to testify today. Government should not pick winners and losers. Government should not tax some businesses and subsidize others, thereby creating winners and losers. And government should not be doing what the real economy, the market, already does or can do better. Some observations. The Main Street Depositor Protection Act will take money from some banks to subsidize the top 1% of accounts. 99% of deposit accounts are covered by the current $250,000 limits. Raising it to $10 million was not worth the cost. Increasing premiums will be paid by the targeted banks to ensure a tiny minority of accounts. These account holders will be even more insulated from the consequences of bad decisions they may make that drag the whole system down. American banks already have the highest deposit insurance coverage in the world at $250,000. The government has failed to prevent bank failures through intervention and regulation. Silicon Valley Bank, First Republic, and Signature, those failures in 23 were localized events that happened due to risky decision-making, and the regulators on the spot failed to follow through with Silicon Valley Bank deposits having numerous red flags. None of the watchers were fired. Now, these failures should not be used as a pretext to give handouts to 1% of accounts. In the past 50 years, 90 banks with over $1 billion in assets have failed despite the regulations and deposit insurance. As a result, many now expect to be bailed out, and they may take risky decisions based on those assumptions. The savings and loan crisis of the 1980s saw hundreds of thrifts fail due to the moral hazard created by raising deposit insurance in the 1980s. Depositors did not care about placing their money at these institutions knowing that they were covered, and neither did the banks. The S&L crisis was resolved through a multi-billion-dollar taxpayer bailout. During the 2000 financial crisis, the FDIC's Deposit Insurance Fund ran out of money anyway, and the depositors still had to bail out the banks. When we raised the number to $250,000, promising the banks even more tax dollars if they lost everyone's money in the future. The Main Street Depositor Protection Act would slow growth and bifurcate the banking system. Every dollar spent on paying insurance premiums to the FDIC is a dollar not in the real economy. Increasing deposit insurance premiums reduces lending and increases borrowing costs, especially at smaller banks. We already have a uniform deposit insurance guarantee, largest in the world. Carving out big and small banks, creating a bifurcated deposit insurance system, and moral hazard by prompting deposit flight to mid-sized insurance institutions that enjoy the $10,000 guarantee. The government should not reward bad decisions by bailing out poorly managed banks and exposing taxpayers to the bailout liabilities. Instead, banks should supplement FDIC with private deposit insurance. There's private insurance in many industries in the United States, and this should be more available in the banking industry. Instead of putting the taxpayer on the hook, which is both a misuse of other people's money and shields banks from the consequences of their own bad decisions, Congress should consider making it easier to opt into private insurance. Now, credit unions currently can only adopt a supplement to the FDIC insurance if a majority of members vote to do so, but can drop private insurance if any majority of any meeting agrees. Banks also should be allowed to meet their insurance or deposit minimums with private options in addition to FDIC. Private insurance can ease pressure on FDIC in crises and create loss and cover losses that would otherwise get bailed out by the taxpayers. The $10 million accounts are the exact sort of depositors that can find and afford private insurance. If these accounts would like coverage, they should pay for it.
Gentleman yields back. Mr. Anderson, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and distinguished members of the committee, I am honored to be with you today, and thank you for the leadership you have shown in drawing attention to this important issue. Deposit insurance has long been a pillar of our financial system and is crucial to the resilience of the U.S. economy. The events of recent years, including the collapse of several banks in the spring of 2023, have raised good questions about the need to modernize this framework. The legislative proposals being considered by the committee and in the Senate are promising efforts to enhance deposit insurance and related financial stability measures. I have 3 main points I'd like to emphasize in my remarks today. First, during the great financial crisis of 2008, the Treasury Department, FDIC, and Federal Reserve Board jointly announced the creation of the TAG program, which provided unlimited deposit insurance coverage for non-interest-bearing transaction accounts at participating banks. The Dodd-Frank Act created a statutory version of the TAG program, but limited the FDIC's authority to create a similar, widely available guarantee program in the future. Under current law, creating a TAG-like program would not just require an affirmative 2/3 vote of the boards of the FDIC and the Federal Reserve, it would also require a joint resolution of Congress. Yet, as we saw in 2023, speed is of the essence during a financial panic, and regulators must act quickly and decisively to resolve failing banks, discourage deposit runs, and limit contagion. Eliminating the congressional approval requirement would go a long way to restoring the potential for a TAG-like program, as was done during the COVID-19 pandemic, to prove useful during future stress events. The ranking member's bill, H.R. 4551, includes a thoughtful approach to fix this problem. Second, inflation adjustment of the deposit insurance limit is a common sense reform that Congress should implement today. In 2005, Congress attempted to address the declining real value of deposit insurance by providing for inflation indexing of the deposit insurance limit with the passage of the Federal Deposit Insurance Reform Act. Enabling future inflation adjustments is a sensible reform that would mitigate the declining value of deposit insurance. The discussion draft posted by the chairman, the Growing Deposit Insurance for the Future Act, suggests such a legislative fix. Third, a major issue is whether to raise the deposit insurance limit for a narrow subset of transaction accounts for legal entities, not human beings. As a practical matter, this means small and medium-sized businesses, 501c3 nonprofits, and religious organizations. Every policy choice has trade-offs, and raising the limit would reduce incentives for some depositors to participate in bank runs, but it would also impose greater cost on banks. The form and the level of increased coverage should be equitable and grounded in empirical analysis based on expanded efforts by the FDIC to collect relevant data, along with significant input from the banking industry and other stakeholders. One discussion draft notice for this hearing does a good job of mandating a study. But a study for study's sake, without a real commitment to empower the FDIC to gather research and make recommendations based on findings, is an exercise of little value. The legislative proposals under consideration would make genuine advances. They would make our system safer. Congress should act now and not delay until the next emergency. The proposals before you have bipartisan support and contain complementary features. I am encouraged by this body's commitment to bolster U.S. financial stability and better arm our regulators with tools to defend against the foreseeable crises of tomorrow. Thank you for the opportunity to testify on this critical subject, and I welcome any questions from members of the committee.
Thank you, Mr. Anderson. Appreciate all of our panel's testimony. We'll now turn to member questions. I recognize myself for 5 minutes for questioning. In my view, it's essential that Congress take a data-driven approach, we've heard that from several of you today, to evaluate any potential reforms to the deposit insurance framework. One challenge in evaluating proposals in taking the approach of raising coverage limits for certain accounts is the potential cost to the banks and the deposit insurance fund are uncertain, as well as the amount of deposits that would be covered and how depositors and banks might respond to those higher limits, especially since deposits would shift to accounts with higher insurance limits. Another issue is that the FDIC call report lumps together individuals, business partnerships, and corporations when banks report transaction and non-transaction accounts, and then further lump all of those together for reporting of insured versus uninsured deposits. So there's ambiguity between interest-bearing and non-interest-bearing account classifications. Acting FDIC Chair Travis Hill referred to some of these data gaps in his recent nomination hearing and acknowledged as much back in July of 2024 after the agency issued a request for information on deposits, when he said we need more information to differentiate among types of uninsured deposits, and the FDIC should consider collecting more granular and frequent deposit data. This makes complete sense, given that banks today do not report comprehensive data on the composition of insured and uninsured deposits in their regulatory call reports, and that granularity of the data is collected is limited. And somebody who spent most of my career in this business, I couldn't agree more. Mrs. Castilla, is that an accurate description from your point of view running your bank in Edmond?
Chairman Hill, it is an accurate reflection. And the data is very difficult, not only for you to be able to get from the call report, but core systems within banks, especially small banks, do not differentiate some of this information. For instance, for uninsured deposits, we have to manually calculate that information by looking at all of our over 250,000 accounts, looking to see if there's co-owners on those accounts, beneficiaries, and so forth. So it is difficult data to get. And it is true, for like uninsured deposits are not reported for small institutions. The data is also knowing how the shifts will occur in accounts is very difficult to assess. Once you have a higher limit in a non-interest-bearing account, it's very easy to offset that with reduction in interest in loans or higher rates on larger interest-bearing accounts.
And I had certainly in my banking career many individuals who operated their very, very successful small business essentially out of a personal checking account. They weren't incorporated. They were what we think of in legal terms as a sole proprietor. And so would they be covered or not covered in some of these proposals?
It's really difficult to assess because many businesses are doing it. They open the account as a person and then do business as this account.
Another, I think you've raised the issue of your own internal systems, your own contracted software providers, as well as the call report. Very helpful. I don't know what's going on with our sound here, if somebody wants to deal with that. Mr. Ryan, what percentage of your bank's depositors have uninsured balances above the current limit? And what's the typical balance these customers of your bank hold in a transaction account, even if you'd use it as a range?
Sure. Approximately 30% of our balances are uninsured, which is slightly better than I think average for banks our size. And it's not, it's very common to have accounts with, multiple millions of dollars sitting in them. Think about universities and hospital systems who have large payrolls and lots of need to pay suppliers and things like that.
Thank you. Ms. Castilla, the same question to you. You run a $400 million community bank. Congratulations on being one of 12 women-owned banks in the country. That's terrific. And same question for you. Tell me how you look at uninsured deposits among your depositor base.
Yep, so we minimize our uninsured deposits, and we mirror also if we have uninsured deposits of 10% of our assets, we make sure we have on-balance sheet liquidity to equal that amount. We maximize the use of reciprocal deposits primarily to be able to maximize coverage for our customers. And also, as a trusted advisor in our customers' financial journey, whether they're a consumer or a business, we help them identify now with higher interest rates, a non-interest bearing account really isn't suitable for a business that's keeping large balances. So we'll set up sweep accounts so that the bulk of their balances are set in a interest-bearing account, and they sweep over as needed when they write those checks or they have payroll processing into the non-interest-bearing account. We're also able to automatically sweep into reciprocal deposits to cover hundreds of millions of dollars.
Thank you very much for everybody's testimony today. My time has expired, and I now call on the ranking member of our full committee, Mrs. Waters, for 5 minutes of questions.
Thank you very much. I have a question for Mr. Anderson. However, before I do that, I'd like to congratulate Ms. Jill Castilla as president of a women's bank. It's good to see you here sitting among so many men who come here on every issue, and particularly on banking issues. And so I hope that you're with us as we move for the possibility of increasing deposit insurance, and I hope women benefit from it. Having said that, Mr. Anderson, in the aftermath of the failure of Silicon Valley Bank, Signature Bank, and First Republic Bank in 2023, the Biden administration took emergency action to protect depositors and prevent contagion, which I'm glad they did. Many businesses, however, got nervous about their payroll accounts being held by smaller banks, and they moved their accounts to the mega banks, thinking that they were too big to fail. A year later, a much smaller bank in Oklahoma, First National Bank of Lindsay, failed as well, but their failure was too small for regulators to use emergency tools to protect depositors. The failure resulted in small businesses, churches, and other customers with more than $250,000 to lose some of their money. According to the FDIC, it was the 37th time uninsured depositors lost money in a bank failure since 2007. To recap, small businesses that banked at SVB were protected while those that banked at this Oklahoma bank lost money. How is that fair? My bill, H.R. 4551, the Employee Paycheck and Small Business Protection Act, would address this problem with a data-driven approach to expand deposit insurance in a deliberate way, considering the benefits and costs to ensure a higher threshold is set so community banks and credit unions can compete for small business deposits in their communities, and those businesses and their workers are better protected. So I'm thankful Chairman Hill posted my bill for this hearing, and I note that the chairman posted several Republican bills on this topic that overlap a lot with mine. So, Mr. Anderson, based on your work with various banks and even payroll company during the 2023 regional bank crisis, how important is it for this committee to work together and not just study this issue, but ensure action is taken to increase the deposit insurance threshold for business payment accounts?
Ranking Member Waters, thank you for your question. I think that your proposed bill, HR 4451, includes a lot of really valuable aspects, particularly the recommendation to reinstitute the TAG program without the need for congressional authorization. It's important to take some of the lessons learned from the 2023 banking stress and apply them, considering that there's a significant amount of bipartisan support for legislation today.
Thank you very much. You mentioned in your testimony that you absolutely supported my legislation. And I'm wondering, as we look at, the others here, would this also be good for women, women-owned banks, or banks that target and support women?
I think that the legislation that you've proposed and significantly the tag provision and the request for the FDIC to conduct a study to determine what a potential increase for non-interest-bearing transaction account, what the coverage for those accounts would be beneficial not just to MDIs, but to community banks and mid-sized banks, and the system overall, especially to the extent that it's equitable amongst the industry.
Well, I thank you for being here today, and I yield back the balance of my time.
Gentlewoman yields back. Chair recognizes the gentleman from Michigan, the vice chair of our full committee, Mr. Heisman. You're recognized for 5 minutes.
Thank you, Chairman Hill. And last Congress, this committee, including my oversight and investigation subcommittee, spent a considerable amount of time on trying to find out the why of the failures of Silicon Valley Bank, Signature, and First Republic. While discussions over raising the deposit insurance did happen, as we received more information, a different narrative did begin to emerge. Our findings concluded, which supported the findings of the FDIC's own report, that SVB's board of directors and their senior management ultimately made poor decisions and failed to mitigate risks. So then the question becomes, if we are indeed going to raise the deposit insurance cap, and I say this without trying to prejudge this, what problem are we trying to solve? What are the other potential solutions, and what are those consequences seen and unseen? And Mr. Norquist, I'm going to start with you quickly. You mentioned in your testimony that 94% of all deposits at Silicon Valley Bank were uninsured, which included venture capital and tech funds, not to mention their ag loans and ag clients, which really all you have to do is read wineries in that. As someone who owns a small business and who has frankly been denied loans for equipment and for real estate projects because of a concentration of risk in our own industries, I don't think this ever should have been allowed to happen. But of course, because of FDIC's systemic risk exemption, the depositors felt no risk. So here's my question. What lessons should we draw from the failures of SVB, Signature, and First Republic with respect to uninsured deposits?
It was certainly a failure of the regulators who red flagged it, but nothing was done. And the idea of bailing everybody out, even people who didn't have insurance, tells the world that you don't have to get private insurance and people will take care of you. It allows people to take greater risks and be assured that somehow they'll be bailed out. It needs to be clear to people that there's FDIC, which is now, again, the largest amount that's insured in the world is in the United States in terms of the dollar amount, $250,000 now, never mind $10 million. The other question is, when we went to $100,000 in the 80s, that's when you ended up with a savings and loan. Increasing the FDIC did not reduce risks. It increased risks because people thought that banks said,
The moral hazard question.
yeah, the moral hazard, and it says we will nationalize, we'll share in any pain, and I won't have to pay if things go bad. But if I have a risky bet and it does well, then I look really good. And if it fails, hey, somebody else is paying.
All right,
for
thank
it.
you. I need to move on quickly. Mr. Ryan, you're on the board of the American Bankers Association, serving as its vice chair. I feel your pain as a vice chair. ABA's current chairman and fellow Michigander, Kenneth Kelly, led a task force earlier this year which produced a series of final recommendations on deposit insurance modernization. I will note these were approved unanimously by the ABA's board of directors. Mr. Chairman, with unanimous consent, I'd like to put the report in.
Without objection.
Thank you. And Mr. Ryan, could you please summarize quickly the ABA's views on deposit insurance reform?
Sure, and I appreciate your vice chairmanship. But there were a number of broad-based support. Deposit insurance reform and raising the limits was at the top of that list, including more information on that topic. But there were a number of other actions, including the emergency measures that have been discussed today, improved transparency around systemic risk designations and special assessments, the insurance, how we calibrate the fund and the stability to do that, deposit insurance assessments, making them tax deductible like any other insurance that banks pay today. So there were a number of resolutions included in its recommendations, but I think those are the big highlights.
Okay. In my remaining time, I'm going to turn to Mrs. Castilla. As a community banker, and frankly, as a woman-owned bank yourself, you just heard the ranking member cite this being a security for women-owned banks. I saw a bit of a grin come across your face. Do you care to address that? And do you agree that community banks will not have to pay for this increase in deposit insurance?
Thank you for that question. This bill, if we went forward with non-interest-bearing account insurance coverage skyrocketing for refilled, I don't believe I would have any benefit from this type of legislation. I'm currently covering those customers with market-available tools. I may be able to save a little money depending on what the cost ended up being compared to the 12.5 basis points I pay for reciprocal deposits. The cost coming to community banks, the proposal that I've seen has a 10-year transition period in which we would supposedly be excluded, but the language says that it's just related to this particular account insurance coverage increase.
Thank you.
So our time has expired, Mr.
Okay.
Chairman. I seek unanimous consent to submit a series of letters: American Insure Insurance, American Action Reform, Independent Bankers of Texas, Wall Street Journal Editorial Board, and others.
Without objection, those letters will be included in the record, and I thank the woman from Oklahoma. Please continue your answer in writing to the Vice Chairman. It's now my pleasure to call on the gentleman from California, Mr. Sherman, who's our ranking member on our Capital Markets Subcommittee. You're recognized for 5 minutes.
Couple preliminary comments. It's discussed, why did Silicon Valley Bank go down? And I believe one person said they made poor decisions. No, we have a poor system. They made decisions that were consistent with the profit motive of the officers and directors of Silicon Valley Bank. They lent long. They borrowed from their customers short. They realized they had a mismatch, and that if interest rates went up, they could lose a fortune. They bought insurance against that and then sold the insurance at a profit, justifying bonuses to the very people who made the decision. If we do not require mark-to-market of securities that are held, we will have a bad system, and it will be in the interest of bank boards of directors and officers to make the same poor decisions. As to the matter before us today, I want to commend the ranking member for her bill to say, let's study this. There has not been the academic, but especially the government studies that I'd like to see. A couple of years ago, I thought and said that maybe we should increase to $1 or $2 million, and maybe we should. But if we're going to go up to 10, or even consider up to 10, I commend the ranking member for her bill, and let's see what the impacts are. I'll point out that there are two ways that investors are made whole. One is FDIC insurance. The other, some of us remember from 2008, is government bailout. Mr. Norquist, I want to thank you for your consistent, if often mistaken, dedication to your ideology. I think the only thing worse from your standpoint than FDIC insurance is government bailout, because then the general taxpayers are paying and the people benefiting never even paid into any insurance system. We had before, we're here talking about non-interest-bearing transactions accounts, mostly at banks, but there's a rival, and that's the stablecoin, also a non-interest-bearing transaction account. We had a vote in this committee where I proposed we have a clear law, no bailouts for stablecoin. Every Democrat voted yes, every Republican voted no. Should we make it clear to stablecoin investors that they're not going to get a government bailout?
Well, I would certainly be in favor of bringing down the amount of available bailouts and the reasons for giving them. I certainly think that there are a lot of things in my written testimony. I go through some of the private sector solutions that exist even in Massachusetts, where I grew up before emigrating to the U.S. Real success in having, going back to 1934, to having private insurance. So when you've got the government so involved already with FDIC and going up to $100,000 didn't make things better, it made things worse. I would suggest we go in the other way and open alternatives.
I want to squeeze in one more item. One of the things about the proposed bill in the Senate is that every bank pays, but the biggest banks don't benefit. And the question is, how will that affect us both on a sunny day and a deluge? On a sunny day, I don't think that businesses are going to take their money out of Bank of America if that's the closest bank. I don't think this is going to be a system that moves capital from the biggest banks to the medium or smaller banks. But if there's a deluge, then small companies that have $1 million or $2 million in a big bank are going to come before the American people and say, I did something reasonable. I had my money in the big bank. I need it to run my business. On the same day, the business owner across the street had his money in a smaller bank and is covered by FDIC insurance that my bank has been paying for. And with that kind of argument, and having been here in 2008, I think the big bank accounts end up getting bailed out by the taxpayer. Is it reasonable, I'll ask Mr. Ryan, to have a situation, not from the standpoint of the bank, but the standpoint of the small business, that if a small business has their money in a big bank, they don't get FDIC insurance?
The deposit system and confidence in that system is critical to the success of the American economy, and the numbers of small banks continue to decline. And I think FDIC insurance modernization helps, that decline from slowing for sure.
Thank you.
Thank the gentleman from California. Now recognize the gentleman from Oklahoma, the chair of our Monetary Policy Task Force. Mr. Lucas, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here. And of course, I want to extend a particular welcome to my fellow Oklahoman and good friend, Mrs. Castilla. Today, our banking system is healthy, wealth capitalized. Our strength is in the diversity of our nation's banks, in size, business model, and specialization. But when it comes to deposit insurance and failures, there is a difference in how the government treats banks of different sizes. We saw this most recently when the FDIC provided a backstop for the systemic risk exception for the big banks that failed in the spring of 2023. But when a small bank in Oklahoma, which a number of my colleagues have alluded to, failed last year, that exception wasn't invoked. Depositors weren't made whole. When people hear that their deposits may be safer in a larger institution because of that implicit guarantee by the government, our smaller banks are left at a competitive disadvantage. I want to focus my questions today on Secretary Bessent's support, Treasury Secretary, I should say, support for expanding deposit insurance to non-interest-bearing transaction accounts as a part of President Trump's community banking and Main Street agenda. Importantly, Acting FDIC Chair Travis Hill has testified that based on the FDIC's estimates, they would not need to raise assessments for this expanded coverage. Though not a silver bullet, this reform is a much-needed improvement and could be part of a broad array of changes that must be made to strengthen our banking system. Mr. Ryan, the FDIC's report on deposit insurance reform after the large bank failures in March of 2023 says that increasing deposit insurance coverage to business payment accounts is the most promising option to improve financial stability. What are the benefits to financial stability and increased competition with expanded coverage for these types of accounts?
America needs banks of all sizes, and I think having a diverse and healthy banking system requires a lot of us. And I think that's what's unique about the American banking system. So having increased deposit insurance limit, I think reinforces the stability and the strength of this very diverse system we have today.
Continuing with you, Mr. Ryan, your testimony highlights the role small and mid-sized banks play in access to capital for Main Street businesses. How would an expansion of insurance coverage for accounts that businesses use for their payroll and operating expenses affect local economies? What's the real net effect?
Small and mid-sized banks like Old National are closest to its customers, and we are involved every single day. I wake up every single day and think about Evansville, Indiana, and I think there aren't any big banks in Evansville, Indiana. So I think it's important to have this big, diverse group of banks serving local communities. Without banks in local communities, they're just not as strong.
Mr. Ryan, are you concerned about an increase in moral hazard with a targeted reform approach? Picking winners and losers, I guess, is what people would say back home.
Thank you for that question. I think that non-interest-bearing accounts avoids this moral hazard question. It's not a moral hazard to protect small businesses.
Mr. Ryan, I've been on this committee a little while, and I've been in this world for a little longer than that even. There's some lessons that seem to be hard for us to learn occasionally. I think you would agree the most relevant lesson from the savings and loan debacle was when you take short-term deposits and make long-term obligations, you're exposing yourself, correct, sir?
Correct.
And that's a fundamental flaw that we see used in other financial decisions and institutions to this day. True?
True. I made a representative. Deposit insurance reform is no substitution for poor management. Poor management is on those board of directors and that management team. This is no substitution, but deposit insurance reform in a contagion, in a crisis mode, can certainly slow down a crisis and give the FDIC and other regulators more time to correct, what are systemic problems exist.
I've been here long enough to know that when the wheels come off, when we slam into the wall, we will do amazing things that usually are incredibly expensive and sometimes destructive in a hurried response. Preparation is better than catastrophe management, correct, sir?
Correct. This is about an ounce of prevention versus trying to manage a crisis after the fact.
I hope this is the first of several hearings on this subject matter. And with that, I yield back, Mr. Chairman.
Gentleman yields back. Gentleman from New York, Mr. Meeks, the ranking member on our House Foreign Affairs Committee. You're recognized for 5 minutes.
Thank you, Mr. Chairman. And I want to just jump in and first thank Ms. Castilla also. I want to thank you for your service to our country. I want to thank you for sharing your story and that your testimony. I thank you for that because it reflects your exemplary leadership within your institution and community, but it also embodies the qualities of community banks, and it's something that they should represent and how they represent. So thank you for that. And in your testimony, you mentioned that reciprocal deposit networks like IntraFi allow community banks to provide full insurance coverage for large depositors without requiring Congress to raise the FDIC insurance limits. And you also note that many community banks, and I think this includes yours, absorb the cost of these networks so that customers can receive expanded coverage seamlessly. Sort of businesses, community businesses, they can be there and do what they need to do. So, community banks, you already pay FDIC assessments to insure deposit up to $250,000, correct? And then you must pay additional fees for private reciprocal networks to provide full coverage for larger depositors, generally businesses in communities. And so for smaller banks operating on thin margins, those dual costs either squeeze your lending capacity, is that correct? Will they squeeze your lending capacity, or will they get passed on to customers? One or the other has to happen. Is that not correct?
Sir, thank you for your question. So we pay interest on these deposits, so the customer receives income from an interest-bearing account, and then we absorb the costs associated with that, so it's higher interest costs. But we're able to maintain a margin over 4%. And I'm in a climate, in a community where there's large banks, mid-sized banks, and community banks. And I can compete against them and win. And we do the competition that we have, the way that we win is through trust. Just like you were outlining as to the efforts that we do and that other community banks do, we were able to have a competitive advantage because of trust. So we were able to maintain a margin, pass along income to customers with those large balances, and be able to deploy those into assets that serve our community.
So what always as I looked at it, this seems to be like a two-tier system. And whether that is fair on community banks or not, because I'm a big advocate for community banks to be able to do more in the community. This is both for urban and rural communities. So this double paying does not seem to be fair to me on its face. But how would you answer that?
So there's lots of things in business that aren't fair. But I will say that we are able to pay our customers interest versus being in a non-interest-bearing account with insurance, so they're receiving that benefit. And through the work that we do with them, we're able to have stable deposits that we can deploy. Our deposits are up 26% since the failure of Silicon Valley Bank. I contribute excess liquidity of over $30 million daily to the rest of the system because we have our deposits outpace our capital growth. So I did not feel disadvantaged, sir.
Thank you. This is why I think this is a very important hearing, because I think we could get something bipartisan done here, working together with the chairman and the ranking member. Let me jump to Mr. Johnson real quick, because again, on the community banks, they often depend on the federal home loan banks for affordable liquidity. And so how can policymakers reinforce the partnership between the FDIC and the federal home loan banks so that both systems work together to safeguard stability?
Thank you for your question, Congressman, and it's good to see you. I think that any material reforms to the FDIC deposit insurance framework, as well as the resolution and receivership process, should be done and taken with the perspective of other emergency lending and liquidity tools, in addition to the federal home loan banks, as well as the discount window, which Senator Warner has proposed a bill to make reform for and to ensure appropriate discount
Let me
readiness.
just try to get one more question in real quick, because share your thoughts on how critical CDFI fund and investments are in MDIs for supporting growth in rural and underserved communities.
You should answer that question in writing. But it's a good question, and I thank the gentleman from New York. I now yield to my friend from Texas. Mr. Sessions, you're recognized for 5 minutes.
Mr. Chairman, thank you very much. My thanks to the panel also. I think all five of you represent marketplace answers and ideas, and I appreciate it. I am more along the line of the prior two speakers who have spoken. I think that Mr. Ryan and certainly Mr. Furlow have spoken to. I have great respect and do agree with Mr. Norquist on government bailouts and where that happens. But I happen to believe that we have some bit of a problem with the structure and its effect that we should look at. And perhaps this goes more to Mr. Furlow's conversation and certainly Mr. Ryan's discussion about what are we really after. And certainly Ms. Castillo openly said we need banks of all sizes. But there is a dominant effect, I believe, against smaller and community banks. And I think the deck is stacked against them. We brought up SVB today and the impact of that and who the winners were, who the losers were. I began dealing with Mr. Furlow at the time of that about what might be concrete answers. And it's hard in this place to get so many people on one side or agree with the other. But I believe that we have yet to talk about the role of regulators and their responsibility in this also. I think we have failed to talk about a number of things at banks, community banks, smaller banks, that involve criminals and assaults against their accounts, financial institutions, notwithstanding banks. And I think that Bill Huizenga has done a good look, good view, proper view of his oversight of the regulators and that balance. But I will tell you that I think we've got to aim at a philosophy about how we're going to level a playing field to make sure that community and smaller banks not just compete fairly, and I know Ms. Castillo said, oh, they can compete, not a problem, but I think that when it really comes down to it, in particular, when there is a problem, they lose. When there is something in the marketplace that happens, whether it be SBB or other things, I think by and large, we lose community banks. I think people move their money. Now, much of it could be because I live in Central Texas, and that's what I hear. I hear people from Waco to Nacogdoches to Lufkin, and they have varying needs and varying desires. But I think we've got to get to what the structure is that we're trying to get at and get a better understanding. And I think that that's what this event is about today. I think the hearing is to hear how somebody in Oklahoma really did a great job with the debacle from SVB, and then look at the facts about some others. So I am looking for an answer. I'm looking for a healthier, in which we have a healthy financial system for everyone, big banks, everyone in the country. But I think that we've got to go more to a structure, and I've used that word now 3 times, a structure that we understand what we're trying to get out of the end result. Regulators, the money, whether it's $250,000 or whether when there is a problem, how we're going to resolve that and who pays. Mr. Furlow, help me out with my thinking, because I think that I've been coached well, but it's my philosophy to understand this from a philosophical perspective. Help me out here.
Congressman, thank you for the question. I think just the range of issues that we've talked about related to deposit insurance today points out that this is a complex issue. It's a complex matter. It is not going to be easy to fix, and that's why the Texas Bankers Association, along with 6 of our colleague associations from Middle America, are proposing this 2-step approach to deposit insurance reform. The first is to make sure that we quickly have an emergency tag capability in place in case there's another systemic emergency. It's easy to forget that we've had 2 systemic crises in 5 years. What will be the next thing that happens? We just don't know. And so we need to have an emergency tag capability in place while we quickly, and I want to emphasize quickly, move to the modernization side and have these open discussions about so many of the questions that remain, whether it be on what the threshold should be, how we handle bank resolution. Again, that's why we're promoting a 2-step process.
Thank you. One more second, please, Mr. Chairman. And I believe we should learn from the past, and regulators have a responsibility to come and aim at systemic problems or issues as opposed to really many ancillary things that they get involved in for 3 weeks at a time. Thank you, Mr. Chairman.
Thank you, Mr. Sessions, very much. I'd call on the gentleman, great gentleman from Georgia, Mr. Scott. You're recognized for 5 minutes.
Ms. Castilla, welcome. I want to ask you about the moral hazard and the impact of raising the deposit insurance cap from $250,000 to $10 million. And my understanding is that none of the proposals for expanded coverage would relax bank supervision and regulation to guard against excessive risk-taking. But here are my concerns, which involves blurring the lines between insured deposits and private capital, signaling that all liabilities are implicitly backed by us in the federal government. And in your recent op-ed, you say that this type of behavior can distort competition and weaken the very discipline that deposit insurance is meant to preserve. So my first question to you is, can you share which specific categories of bank risk, liquidity, concentration, credit, would be the most sensitive to a higher guarantee?
Thank you, sir, for that question. I love this question because the moral hazard can be quite complex. Right now, the current market tools that allow for insurance coverage for individuals beyond the $250,000 limit, it has restrictions, regulatory restrictions from allowing troubled institutions to increase their exposure to the fund. So 4 or 5 rated banks, their troubled condition cannot participate further. They're frozen in their activities with the Federal Home Loan Bank and reciprocal deposits. If you increase deposit insurance, there is not that restriction within the FDIC. They would have up to that limit, and they could bring other customers on. They could compete in the marketplace offering higher rates or better toasters and take customers from well-managed community banks because they need the liquidity, and you could have a failing institution increase its exposure to the fund.
And let me also ask you, are there any targeted coverage categories where moral hazard concerns are lower?
It's a great question, and it would require more research and analysis on that. I don't feel like I have the expertise to potentially cover that.
You know, I don't like the idea of inviting regulatory complacency or allowing management, uninsured creditors, or shareholders to offload risk onto the public safety net. But would enhanced supervisory oversight of interest rate risk or concentration risk reduce the behavior incentives created by higher coverage?
Sir, frankly, the current supervisory framework should catch this mismatch of interest rate that we saw at Silicon Valley Bank and other banks. I could not get away with this behavior. We have, our interest rate risk is analyzed every 18 months, and even if they see a call report that follows askew in some way, I'm getting a call, sir.
Now, Mr. Anderson, welcome. In the 1980s, the U.S. experienced a wave of bank failures that resulted in over 700 bank closures and costing the economy $300 billion in $25. So my question to you is, do you see these proposals having a similar impact? And could we be increasing risk to financial stability?
I think that the proposals before the committee today, taken collectively, actually are a net positive in reducing financial stability risk to the system. There are a lot of valuable components, particularly instituting a tag-like program and inflation adjustment for the deposit insurance limit that are reasonable, sensible solutions to help enhance financial stability.
So you're not worried about anything in this area, are you?
Not anything that keeps me up at night. I actually am very much encouraged by the bipartisanship within this committee and some of the reforms that are on the table.
Thank you very much.
Thank you.
Thank you, Mr. Scott, very much. The chair recognizes the gentlewoman from Missouri, the chair of our Capital Markets Subcommittee, Ms. Wagner. You're recognized for 5 minutes.
I thank you, Mr. Chairman. My home state of Missouri has a huge variety of banks, ranging from community and regional banks all the way up to globally systemically important banks, or GSIBs. As of last year, in fact, Missouri had the 4th highest number of state-chartered banks in the United States. Missouri represents what makes our banking system great. These varied institutions can address the different needs of our community, from a young married couple buying their very first home to the entrepreneur who needs a loan to grow a startup. This variety is unique and one of our economy's biggest strengths. Any changes to our deposit insurance framework should ensure that the variety and the diversity of our banking system is preserved so that all customers can access banking that suits their needs and any negative impacts are minimized. Mr. Norquist, it's good to see you again, sir. What potential pitfalls or moral hazards and market distortions can be created if deposit insurance coverage limits are raised and conditioned on a bank's size?
Oops. Well, you might see people moving their $100 million into 10 smaller banks where they're each covered. So you'd have some movement of capital, perhaps chasing after government insurance support. I think there's a challenge when you take money from one part of an industry and hand it to another part of the same industry. That's picking winners and losers or creating winners and losers right there. And that we should take a look at what happened in the 80s when we did, for all the reasons that we're hearing here, the government, increased the coverage to 100,000 from 40,000, and we ended up with massive misallocation of resources and a lot of bankruptcies beyond what the insurance would cover, largely created by the government deciding that almost everything was going to be covered, and people made decisions thinking that if they lost the money, that everything would be okay, so they were much more risky.
Thank you, Mr. Norquist. Mr. Furlow, in your testimony, you mentioned the Transaction Account Guarantee, or the TAG program, a temporary program established by the FDIC in 2008 to provide unlimited deposit insurance on non-interest-bearing transaction accounts at all banks. Several groups, including the Missouri Bankers Association, have recommended providing regulators with the authority to establish a TAG program as a first step towards a more comprehensive restructuring of our deposit insurance system. Can you compare the effects on the banking sector and depositors' behavior of the following policies: the current systemic risk exception, the TAG program, and the permanent increases to deposit insurance limits?
Yes, ma'am. Thank you for the question. I think it really gets to the heart of why we're proposing a two-step approach. And we're grateful for the Missouri bankers being a part of this coalition. And really what we're trying to get to the heart of is how do we bring fairness for all banks, to include our community and mid-sized banks. I look in the community, for example, in Kittiquay, Texas. First National Bank in Kittiquay, Texas is systemically important in that community, to ag producers in particular. Yep. And yet, during the last crisis, that bank didn't know if their depositors were going to be covered. And so making sure that we have in place immediately the ability, in case we have a systemic crisis between now and when we figure out all of these other factors that we're discussing today, is terribly important.
Thank you very much, Mr. Furlow. Ms. Castilla, as I mentioned earlier, we have a wide variety of banks in Missouri, including many community banks like your own. How would proposals to change deposit insurance limits affect those different sized banks?
And I thank you for that question. The show me state is, I'm going to use that moniker, and that, I think we need a show me on the data and do a really in-depth analysis to see how each of these size institutions will be affected. I think the assumption right now is if there was a large increase in deposit insurance, that you potentially could see a flow back of funds to large mid-sized banks from small institutions and the largest institutions, because during the SVB crisis, since then, small bank funding has remained consistent, and so we were with the receivers and also kind of the losers together with a net zero.
Thank you, Ms. Castilla. My time has expired. Mr. Bryan, I have questions for you, but I will put them in writing. Thank you so much, Mr. Chairman. I yield back.
Thank the gentleman from Missouri. We'll now recognize the gentleman from Massachusetts, Mr. Lynch, who's our ranking member of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee. Thank you.
Thank you, Mr. Chairman, and I want to thank all the witnesses for your testimony this morning. I just want to add to Mr. Sherman's remarks around the failure of Silicon Valley Bank. They also did not have a chief risk officer in place for the 8-month period before their collapse. That might have helped. You know, since the mid-1980s, the number of commercial banks in this country has declined by about 70%, with consolidation mostly occurring in relation to the largest financial institutions in the country. This trend, again, accelerated in 2008, as we all know, and during the 2008 financial crisis. And most recently, the collapse of the banks that we're talking about this morning, First Republic, Silicon Valley Bank, and Signature Bank, which were the second, third, and fourth largest bank failures in U.S. history, resulted in J.P. Morgan Chase actually growing by $173 billion in deposits and $229 billion in loans following their acquisition of First Republic. In the wake of these failures, our committee, Democrats and Republicans, have continued to evaluate long overdue reforms, not only to prevent the failures in the first place, but also to look at the resolution process. And I know Mr. Furlow and others have mentioned that aspect of this. To this end, Chairman Hill and Ranking Member Waters were kind enough to attach my bill called the Failing Bank Acquisition Fairness Act, which would ensure that smaller and mid-sized and regional banks would have a shot when a bank fails, instead of, rushing to push those deposits and loan activity to another mega bank or GSIB. And just like to get Mr. Anderson, if you could talk about the view of offering mid-sized regional banks, and I'm going to ask Mr. Ryan to comment afterwards as well. He's got a good perspective there from Evanston and also, all over the Midwest. What would that mean if we actually allowed strong mid-sized and regional banks to take over some of these failing banks instead of, making J.P. Morgan Chase even larger?
Congressman, thank you very much for your question. I generally support the principle that Congress should preserve the policy already in our laws, which limits the largest banks to 10% of total deposits in the U.S. And not.
Well, we've got an emergency clause there for failing banks, so it doesn't apply. That's what I'm, okay.
In a crisis scenario.
Yeah.
I think, consistent with some of the recommendations from the ABA white paper, which has been submitted to the record, having the opportunity for community banks and mid-sized regional banks to participate in bank failures is probably a pretty good idea. That is going to be limited by the complexity of the failed institution and the size of the institution and the assets that it holds.
And time is of the essence. I do agree with you. I just want to go to Mr. Ryan and let him have a couple of words on this.
I'm sure the committee knows this, but mid-sized and community banks regularly lend out 75 to 80% of its deposit base. The largest banks in our country only lend out 55% of their deposit base. So having more small and community banks and mid-sized banks creates more lending opportunities and more economic development in our communities.
Thank you. One other issue. Last week, Michelle Bowman, she's the vice chair for supervision at the Federal Reserve Bank, spoke at a banking conference in Madrid. Santander, I guess, ran that. But she advocated that it is critically important that traditional banks are able to engage fully in the digital asset space and compete, these are traditional banks, and compete with non-bank financial institutions by integrating cryptocurrency. That would seem to blow up all of the risk control, all of the protections that we put around banks, and I'm just wondering, that seems to be a crazy idea, in my opinion, thinking about what we're talking about here, deposit insurance, to import the most volatile and risky of assets, speculative assets. And I don't know, Mr. Ryan, you got some thoughts on that?
Well, I do think we need to tread cautiously when we're talking about fintech companies who operate a lot like banks, or we're talking about stablecoin entities and Bitcoin companies and things like that. I think we need to tread lightly, particularly around any government implied or explicit guarantees.
Okay, thank you. Mr. Chairman, I appreciate the courtesy, and I yield back the balance of my time.
Gentleman yields back. It's a pleasure to recognize the chair of our Financial Institutions Subcommittee, the gentleman from Kentucky, Mr. Barr. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thanks to all of our witnesses for your insightful testimony. What we're talking about here today are policy alternatives and there's trade-offs. And so thanks for helping us get to this. I want to scrutinize two topics. One, the Haggerty-Also-Brooks legislation and the potential cost of that. And secondly, this E-tag concept. Mr. Ryan, thanks for Old National's presence in Kentucky and the Commonwealth and the contributions to economic activity, especially in Henderson and in Lexington as well. I do applaud your efforts to try to protect those mid-sized institutions like your own, but I am concerned about the Haggerty-Also-Brooks cost. Let me ask Mrs. Castilla to amplify this idea that the effect of increases in deposit insurance on premiums that institutions pay, and will these costs be borne by the institutions themselves or customers, as you said, in the form of lower interest paid on deposits, higher interest paid on loans, and other increases in fees?
Thank you for the question. So I look at this bill as being more of a buy now, pay later type of scenario where I don't really know the cost. We're utilizing already paid in assessments to subsidize some of these costs, with an exception stated for community banks, but still using these assessments that we've already contributed to subsidize the cost of this legislation.
And Mr. Ryan, can I go back to you? I want to give you a shot here. Because, Ms. Castilla's testimony is that the lesson of 2023 is not that $250,000 limit is too low. Confidence doesn't come from insuring every dollar. Why couldn't Old National or banks of your size use, as Ms. Castilla argues, collateralized deposits, Federal Home Loan Bank letters of credit, reciprocal deposits as amplified by our legislation? Why is it that Haggerty is the only answer here?
We certainly use all those tools. However, I would suggest to you that during times of crisis, they're very complex, they're expensive to administer, and our businesses, quite frankly, would prefer to stick to FDIC insurance.
I understand that. Let me just ask one final question about the Haggerty-Also-Brooks proposal. The proposal would have the FDIC spread its recognition of insured deposits over a 10-year period in order to get the reserve ratio. Mr. Norquist, does increasing insurance coverage 40 times what it is today, but not really paying for it except for over a decade, does that make sense to you?
Not particularly.
Let me move on to TAG. I want to, as an alternative to this Haggerty-Also-Brooks idea, I want to enter into the record, Mr. Chairman, a letter from the Kentucky Bankers Association and some of the other state banks associations advocating for an E-tag.
Without objection.
Why, Mr. Furlow, why is the systemic risk exemption inferior to E-tag? I mean, wasn't the failure of SVB and the deposit outflows that we saw as a result of that the result of regulatory delay and indecision over that fateful weekend, as opposed to the absence of an E-tag?
That absolutely was part of it. I mean, y'all remember that weekend. Everyone was scrambling, both on the industry and regulator side, to understand what was going on and what was going to happen before Monday morning. And so the reason that we're proposing this E-tag proposal is to ensure that there's something in place that can quickly be implemented, especially in the social media age when contagion can happen.
Well, I guess my question is, isn't the problem the regulator's failure to execute the systemic risk exception? Wasn't that the issue as opposed to the absence of E-tag?
That is certainly a part of it.
Okay. Well, just in general, Mr. Furlow, can you tell us why you believe that the E-tag program would be preferable compared to across-the-board blanket increases in deposit insurance limits, and whether it would be a cost saver in the long run compared to FDIC resolutions of failed banks?
Well, sometimes I think we forget what deposit insurance is there for. It's first and foremost to prevent bank runs. I think we focused a lot on what happens after the bank runs, who pays, who's going to pay what. The first goal should be to stop bank runs from beginning at the first place. And so with our proposal, if we have a program that is set to be utilized at a moment's notice when we see contagion starting, then we can quickly say to depositors, regardless of the type and size of bank that they're at, you're good.
Finally, Mr. Ryan, why isn't E-tag superior to the costly increase in deposit insurance?
Deposit insurance reform is about prevention. E-tag is about cleaning up a crisis afterwards.
Thank you. I yield back.
Gentleman yields back. Now recognize the ranking member for the Subcommittee on Financial Institutions, Dr. Foster, Illinois. You're recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to our witnesses for a very thoughtful testimony. You know, it's important that we not only look at the past, but also look as best we can into the future and what we're going to be dealing with in the future. It's not going to be customers or businesses. It's going to be their AI agents, all right? And when you're talking about bank runs, you're going to be talking about bank runs that don't occur at the speed of social media, but at the speed of agentic AI, all right? And I'm confident we're not ready for that. Ms. Castilla, you described during the 2023 bank stress, getting your customers on the phone to reassure them. And that was only possible because we had hours or days at most to actually do that. But if this had been happening at the speed of agentic AI, which I'm afraid they will be programmed to, their prime directive will be to keep your money safe, and secondly, maybe do some trust-based, you know, long-term relationship stuff, but I don't think that will be emphasized for most people. And so you're going to have a situation where the agents that are making the decisions in real time are not going to have the customer loyalty that our whole banking system depends on. So I was just wondering, has this, Mr. Furlow, you talked a lot about this and about your first step is at least make sure we're safe against this sort of, what's the current thinking? Does someone have a system that pencils out reasonably that would actually protect us from an AI-driven bank run where everyone's agents read some rumor on Reddit that this bank may be in trouble and they're not sure, they don't have time to check it out, but their first responsibility is to get your money the heck out of any bank that might be in trouble?
Well, first I would say that respectfully disagree with my friend Mr. Ryan that E-tag is responsive. It's preparedness. It's putting in place, whether it is an AI-generated type of crisis, whether it's geopolitical in nature, whether it's social in nature, whatever that crisis is, we're prepared to act quickly in order to protect banks of every size, which is not the status of where we are today. Today, our community banks, our mid-size, our regional banks are very vulnerable to shocks, and 2023 proved it. And it happened extremely fast. And when the age of AI, it's going to happen even faster. And so once that is recognized, when contagion is seen, what we need is a quarterback. We need someone who has the ball to be able to say, we need to invoke this authority to protect banks of every size to stop the runs before they start. That will help to protect the diff.
Yeah,
So
we're also, I think, going to need real-time data collection, all the way down to even the smallest banks. Ms. Castilla, you also described how you had to manually calculate what fraction of your deposits were uninsured. That seems like it shouldn't happen even for a small bank. You should have a dashboard that gives you in real time all of the relevant numbers and frankly report those numbers in real time up to the regulators so they have the information they know. The technology exists to do this. I'm sure all the big banks have the equivalent of that and the regulators, I'm sure, have real-time visibility into this. The cost of this software is going to get massively cheaper with AI-generated software, frankly, and so I think one of the things we may want to think about is trying to make it possible for even the smallest banks to have the highest quality software so that the banks themselves, without having to go and break the bank paying for it, have a way to get industrial strength software that will lower the cost of compliance and make the regulator's job a lot easier because they won't have to worry about collecting data. Has anyone, I'll just go down the line here, who are the thought leaders on that? Who is assembling such a system and thinking about how it can work? Mr. Anderson, you look like you want to say something?
That's a really good question, Congressman. I don't have a great answer for you on the spot, but happy to get back to you about who the thought leaders are on designing that system.
I'm sorry, I don't have a comment on the thought leaders. I will get back to you on that. But I do want to say that we have, just our bank, more than 75% of off-balance sheet collateral sources that we could draw upon if there was a way to integrate that real time. And I think a deficiency we have right now in that type of situation that you described is that we only can access the Federal Reserve in the discount window during business hours, and it's through the wire system versus using FedNow or something comparable where we had real-time 24/7 access to those collateral sources.
Right. And then you're going to have to pre-position those collateral in a way that the Fed has confidence that they can give it an appropriate haircut and give you the emergencies, in the next 20 minutes to stop this bank run.
And sir, we test our contingency funding processes at least on a monthly basis, so
but
they're ready to go.
Yeah, well, it's got to be real time, unfortunately. And
Yes, sir.
that's, I don't think it will end up being exorbitantly expensive. We just have to find a way to not have those costs land on the small banks in a way that they just can't afford. And if there's any thoughts on how to best, frankly, subsidize better software for small banks, I think is the ultimate, going to have to be the ultimate goal here, or else you're always going to have a flight to the large banks when this happens. Is this a job for, I don't know, the Federal Reserve to convene a workshop on this, to actually to write down a system that actually can survive against an AI agent?
And there are several community banking workshops in which we share best practices where this could be pertinent. And we do, although I said we calculate this manually, we have a system internally where daily we can see what our uninsured deposits are. So community banks are scrappy. It just may not be a fancy software system. It may be in Excel, and then we're importing that data from a query, but we're monitoring it on a daily basis.
But your regulators in this kind of run are going to have to know in real time how widespread a problem is. Anyway, my time is up, but I'd welcome any thoughts you had on the way forward on this growing problem.
Yes, sir.
Yield back.
Thank the gentleman from Illinois. We now recognize Mr. Loudermilk, gentleman from Georgia. You're recognized for 5 minutes.
All right, thank you, Mr. Chairman. It's good to be back. I'm reorienting myself to how all this works again. So we had a little break there. But Ms. Castilla, in your testimony, you wrote that the 2023 events were fundamentally a crisis of confidence, not a shortfall of coverage. I tend to agree with you on that. But in your view, how does data-driven reform address this confidence of shortfall of the current deposit insurance framework in a way that simply raising the deposit insurance coverage threshold cannot?
Well, certainly when we go back and look at those bank failures, the supervisory oversight was inconsistent with what community banks face on a daily basis with our regulators. And so to be able to say if you have 95% or 94% uninsured deposits, you better have a lot of on-balance sheet liquidity to handle the liquidity crisis. The data is going to be difficult to get. I think call report data is more limited when it comes to deposits, even for large institutions that report more frequently and more detailed information. But I do think that some of this is imperative going forward.
So how do you think that banks themselves can help ensure confidence for their depositors?
I mean, trust is what banking, that's what we do. That's what community banks do. I don't want the government taking the place of the trust that I get to build in customers. That's what makes community banking so special.
All right, thank you. Mr. Norquist, good to see you again. Even though the additional FDIC coverage would be funded by industry premiums into the DIF, do you have any concerns about costs being passed down to consumers or the American taxpayer?
Well, when you have in effect a tax on the business that says you have to give us this for the insurance because we'll tell you what you get for the money, it's not a voluntary decision by a bank to pay the additional money. And as I understand it, some banks will be paying in to subsidize other banks. So it looks a lot more like a tax even than a mandated fee or behavior. Those things tend to be problematic. You're subsidizing some people at other people's expense. And when you take money out of a bank for insurance or any other purpose, it's not available for other things. So at the end of the day, where else does the bank get money other than its customers? It's like taxes, the property taxes on your grocery store are not paid, by the potatoes. They're paid by people who buy potatoes.
Right. Okay. Ms. Castilla, if I come back with a follow-up on that, as community banker, is that something that would have to be passed along to your customers and increased fees, et cetera?
We would just have to figure out how to navigate around that. You know, community banks have tons of technology pressures. We have to provide the same thing the big banks do. So something would have to give, but we'd have to be scrappy and figure it out. But ultimately, I mean, the customer probably would either have deficient service in some capacity from a technology standpoint, accessibility to services, or potentially cost and what we were able to be able to pay them for.
Right, and generally, customers end up paying all the fees. Now, let me take this a step further, because in the past few years, our friends on the other side of the aisle here have waged war on bank fees. They want to get rid of bank fees, or at least significantly curtail them. So if that was to happen, and I'll open this up to anybody on the panel, to where now bank fees are not allowed, or you're not allowed to raise bank fees, what do you do then, especially for small banks?
It's an impossible question, and it keeps getting more difficult to answer. So if you have, or anybody else in the room has that, I'm all ears, because it is becoming more cost burdensome. And even though I said that we have a net interest margin that's over 4%, it used to be our non-interest expense was covered by our non-interest income. Now there's no way that that non-interest income covers non-interest expense, and the bank's profitability then continues to tighten.
Does anybody else like to take a shot at that?
Yes, sir. One of the challenges, especially for our community banks, is just the stack of expenses that they're constantly facing. And an issue I'd like to raise, because it fits into all of the costs, is fraud. Fraud is a huge problem, especially for community banks. And guess what happens? Oftentimes, those banks are making the customer whole. And so it's easy to attack the fees, but it's our community banks who, if there's a card skimmer that's involved, or someone falls victim to fraud in any way, the community banks are making those customers whole. And when you add the technology, the expense of additional insurance that Ms. Castilla had referenced, they're doing yeoman's work in terms of protecting their customers. And they need, as a business, especially many community banks are small businesses, they need that ability to be able to cover some of those costs.
So we're potentially creating a catch-22 situation, right? All right, with that, Mr. Chairman, my time has expired. I yield back.
Gentleman yields back. Now recognize the gentlewoman from Ohio, the ranking member of our National Security Subcommittee, Ms. Beatty. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member Waters. And to all of our witnesses here, thank you for your testimony and your commitment to community banks. That is good to hear. I've been a big proponent and advocate for making sure, not only for the institutions, but for our consumers, whether it's in rural America, urban America, or even suburban America, we have found a lot of people find comfort in going to their small community bank. So with that, I'll start with you, Mr. Anderson. As you probably are aware, this committee recently passed the Keeping Deposits Local Act, led by myself and my colleague on the other side of the aisle, Congressman Emmers. It went all the way through the markup to expand the use of reciprocal deposits so that community financial institutions can broaden their insurance coverage and compete for larger accounts. Can you share with us or discuss how pairing this legislation with broader deposit insurance, such as what our ranking member Maxine Waters proposed, how would that help small and community banks?
Thank you for your question, Congresswoman. I agree that the expanded use of reciprocal deposits and custodial deposits is beneficial to community banks, particularly the ones that can take advantage of it, and it is quite complementary to the reforms that Ranking Member Waters has proposed, and they don't preclude one another, just given the targets of those bills. I agree that it's important for regulators to weigh in on how these components fit together, and I think part of what the FDIC should be studying is how reciprocal deposit arrangements and potential increases to the deposit insurance fund impact one another.
Okay, thank you. We've heard a lot about community banks, but I am very fortunate in my district. We have one of the newer MDI banks. So, Mr. Anderson, and I'll go down the line in asking others. When we think about federal banking regulators, and they have an obligation under Dodd-Frank to preserve and promote minority depository institutions, or MDI, are there steps that federal banking regulators could take that would build on the bipartisan progress made during President Trump's first term, which provided $12 billion in capital investments and grants to MDIs, and as well as CDFIs?
So, Congresswoman, I very much appreciate your question, in large part because MDIs and CDFIs are near and dear to my heart. When I first began my career in banking regulation at the Federal Reserve as a teenager, the first project I ever worked on was the Partnership for Progress, which is the Federal Reserve's initiative designed to promote and preserve minority-owned banks. So I think that MDIs and CDFIs play a critical role in our financial ecosystem, and it's important that this Congress and the administration continue to take steps to protect and preserve them.
Others? Yes.
Ma'am, as a women-owned bank, I'm a state chartered institution, and the OCC is the only regulatory agency that recognizes women-owned banks as minority depository institution. So although we are part of the Partnerships for Progress underneath the Federal Reserve, we are not considered an MDI with those two, the FDIC and the Federal Reserve. And I believe that's something that could be changed to help there be more inclusivity when it comes to women-owned banks, and hopefully that we have more than 15 down the road.
Thank you. Yes.
Old National's been working for the last 2 years to create Indiana's first minority depository institution called Generations Community Bank. It's been a 2-year long journey to create this organization. And I do think having higher FDIC insurance limits would be helpful to this institution, given it's a brand new institution, and depositors might be less likely or be more concerned about putting anything above the FDIC insurance limits. So I think it's very complementary to what we're trying to do with creating a new MDI.
Well, thank you. And if Adelphi Bank, I hope I'm not speaking for them, but they've been very successful in meeting all their benchmarks and getting through it. I'm sure they'd be willing to talk to you since you're not in Ohio.
Yes, thank you very much. We've talked with them.
Okay, great. I'll let them, Jordan Miller and Kevin Boyce, know. Thank you. Anyone else?
And ma'am, continued regulatory right-sizing. If you look at minority depository institutions and CDFIs, they're overwhelmingly community-oriented, community banks. And if we can make sure that the regulation fits their business model, I think that would go a long way to helping. And
Thank you. My
that's why
time's
making sure
up.
deposit insurance fits that as well.
Gentlewoman yields back. Now, a pleasure to recognize the gentleman from Ohio, the chair of our National Security Subcommittee. Mr. Davidson, you're recognized for 5 minutes.
Thank you, Chairman. It would be great if we lived in a world where the success of a bank is based on how effectively they manage their assets and the level of service they deliver for customers, not where success is based on the size and scope of taxpayer-funded stipends. Unfortunately, this is not the present case, and today we'll examine whether or not taxpayers should wind up on the hook for another $10 million of deposit insurance. The Taxpayers Protection Alliance estimated that the cost of the Haggerty-Also-Brooks legislation for banks would result in a $42 billion special assessment and billions more in added premiums each year. We also have a statement from a coalition of 11 conservative groups opposing an increase in FDIC insurance. I'd ask unanimous consent to submit to the record.
Without objection.
However, some have claimed that increasing deposit insurance would not result in higher costs for banks. So I want to drill down on it and make sure we get it correct. It seems to be based on a provision in the bill that deals with how the FDIC calculates the deposit insurance fund's reserve ratio. It directs the agency to not count the full amount of newly insured deposits and instead spreads costs out over 10 years, which appears to be an accounting sleight of hand to prevent the reserve ratio from going below its statutory minimum. Ms. Castilla, what do you think about this buy now, pay later approach to deposit insurance?
I find it really difficult to understand how this is a disciplined way for there to be fiscal policy going forward. It exposes the fund to so much fragility, and it puts with the fund, it just as Mr. Furlow suggested, is The deposit insurance is the keeps us from having runs. And if there is a perception out there that we don't have the fund to back up our insurance, and this is messing up the math and making it very fuzzy so it's not transparent that the fund is actually adequate, I find that exceptionally concerning. Trying to establish trust with the customer, I have to have the trust in the fund.
Well, we certainly don't like fuzzy math. So when we consider changes to the deposit insurance framework, it's important that we take away the right lessons from the spring of 2023 instead of spinning revisionist history. The failures of Silicon Valley Bank and First Republic Bank were fueled by concentrated uninsured deposits, mismanaged risks, swift deposit outflows due to technology changes, and frankly, supervisory failures. I'd like to point out that in my assessment, Signature and Silvergate were victims of Biden's unlawful war on crypto, and I don't think they were actually insolvent except for that. Mr. Norquist, would raising deposit insurance limits have prevented the failures at these banks?
No.
So, Mr. Anderson, thank you. Mr. Anderson and Mr. Furlow, both of your written testimonies mention how we need to reassess the deposit insurance and bank resolution frameworks together. Why is it important that Congress does both if we're going to take a comprehensive approach to deposit insurance reform?
Certainty. The banking industry abhors having uncertainty. It makes doing business so much more difficult. And when you think, especially the bank resolution process, for example, the failure that occurred in Oklahoma, a lot of folks had questions about how did that process take place. There's a lot of unanswered questions there. So whether it is deposit insurance, so that depositors know that their deposits are safe in an emergency, or the bank resolution process, that there's some certainty to the process and it's transparent.
Thank you for that. You know, speaking of comprehensive reform, another issue that should be addressed in this jurisdiction is interest on excess reserves. Mr. Chairman, I'd like to submit this document from FGA into the record as we discuss padding the balance sheets of banks with FDI insurance in 2024 alone. The Fed paid
without objection.
Thank you, Chairman. The Fed paid over $186 billion in payments directly to banks. This is money from our Treasury to banks because they're holding their balances in the Federal Reserve, money that they don't even have to deploy in their own balance sheets. They don't manage their own balance sheets. They don't even have to do underwriting. They just leave it on deposit with the Fed and take a big break. Instead of sending taxpayer dollars to profitable banks, we should focus on accountability for our financial system and paying down the $38 trillion deficit. FGA estimates this could save over $1 trillion in a 10-year window. Lastly, as we talk about the private sector, I'd like to submit for the record that there is a private alternative. So banks that want to offer insurance to their creditworthy depositors could do their own underwriting, and they could offer a private sector insurance, sort of American share insurance based in Ohio. I'd ask unanimous consent.
Without objection, will be included in the record.
Thank you, Chairman. I yield my time.
Gentleman yields back. It's a pleasure to call on the gentleman from California, Mr. Vargas, who is the ranking member on our Monetary Policy Task Force. You're recognized for 5 minutes.
Thank you very much, Mr. Chairman and ranking member. I think this has been an excellent hearing, and I really appreciate all the comments. In fact, interestingly, when you sit on the second row, most of the things you were going to ask have already been asked by the gentle people on the first row, or the rear row, however you want to call that, the elevated row. So I do have a few questions, however. Mr. Norquist, I believe your first statement here was something like, government shouldn't pick winners and losers. I believe that was one of your first statements. And then I read here also in your written testimony, I testify today against putting taxpayers and consumers on the hook for bank failures. This includes expanding federal deposit insurance coverage beyond the $250,000 limit. An expanded guarantee would magnify moral hazards, slow lending, economic growth, and expose taxpayers toward limited backstop liabilities. Members should understand that raising deposit insurance coverage will only make banks' bailouts more likely. I think all those are correct. And notwithstanding Ralph Waldo Emerson's statement that foolish consistency is a hobgoblin of little minds, you've been pretty consistent. And so I was curious that when the federal government took a 9.9% interest in Intel, many voices were heard, and I don't remember hearing yours.
it wasn't a good idea, and it isn't a good idea for the federal government, state government, or local government to own businesses in whole or in part.
So wouldn't that lead towards socialism when the government is owning businesses like this? Isn't that picking winners and losers? And isn't that the government owning?
It certainly gives the government an interest in the success of that company, which means it will lead, I would think it would tend to lead to government picking winners and losers by buying from that company.
But isn't socialism the
subsidizing that
government
company.
owning the means and modes of production?
Yes.
Yeah, and isn't this the case with Intel then? Government took about a 10% stake in it.
Yeah, it's 10% socialism there.
Yeah, I agree with you.
Yeah, it's not a good idea.
It's not a good idea. No.
I'll write a memo.
And you gave the example, too, of the store that sells potatoes. And you said the property tax on that store is not paid by the store, it's really paid by the customers. Isn't that what you said also?
Correct.
So who pays the tariffs?
Tariffs, well, American tariffs
Yeah.
are paid by American consumers.
That's right.
French tariffs are paid by French consumers.
Okay. Well, I appreciate that. You have been consistent. That's what I do appreciate. Now, I appreciate the diversity of ideas here because I do think that ultimately we can come to some agreement generally. Because I do think the reason we have FDIC insurance in the first place is so there's not a run on the bank. Not really to ultimately what happens afterwards, is so it doesn't happen. I remember the testimony of the 3 CEOs that we've been talking about their banks today, and one of them, basically said, look, I didn't do anything wrong, my bank didn't do anything wrong. The idiot over there on the corner, he's the one that screwed up, and I just got sideswiped. And in fact, a bunch of people that had banked with me for 20 years came to me, and I came to them and said, please don't do this to me. And they said, we can't, we got to get out. We have to go somewhere where it's secure. And so that's what they did. Once the panic sets in, it's difficult to stop. That's what his testimony was. And I kind of agreed with that. I thought, yeah, it probably is the case. Once the panic is in, you want your money out. And so I think we need to figure out this and modernize it without the government being too much on the hook. I appreciate that. And that's why I think studying this thing and getting everyone together, as the ranking member does, I think that's a very good idea. I think that's what we should do, to make sure we don't screw it up and to make sure we do it better and at the same time not expose the taxpayers to a lot of liability here. I think that that's important. So with all that being said, there is one thing that I think we haven't mentioned here that's too bad, but I think it's reality, and that is economies of scale. These big banks have an advantage right now, and that is that technology is very expensive. And yes, modern regulation is very expensive. It's hard to absorb those costs for a small bank or even a medium-sized bank. The bigger banks can do that, and that's why they have economies of scale. That's an advantage. And the second advantage, not advantage, but one of the things I think that's also a truism, the big banks are getting better. I mean, they don't loan as well as I think as the local banks do, and I think that's true. But they're getting better. Their products are getting better. And I think that's one of the reasons why they're growing also. But anyway, all that being said, I appreciate the conversation here today very much and hope we can get to some agreement. You had a question? Yes, sir. Go ahead.
I would just add, I generally agree that they have more ability to spend money in technology. Banks like Mrs. Castilla and our bank, Old National Bank, are better at relationships and being closer to our clients.
Yeah, I think so too. And I think you also, as you said, you loan more, a bigger percentage. I think that's a positive thing. That's why I'm in favor of small and medium-sized banks, but I also recognize large banks have an advantage. And
that proximity to the customer also makes us much more creative and relevant in the technology they provide.
That's right. And with that, I yield back, Mr. Chair.
Gentleman yields back. Proud to recognize the gentleman from Texas, Mr. Williams. He's the chair of the Small Business Committee here in the House. Yield 5 minutes.
Thank you, Mr. Chairman, and also I'd like to say hello to all my friends on the panel today. Thank you for being here. My home state of Texas is home to many community and regional banks, and these financial institutions are the backbones of their communities and help support Main Street entrepreneurs within those communities. And during recent periods of financial instability, even the soundest financial institutions face sudden deposit overflows driven by fear rather than fundamentals. That kind of disruption threatens the stability of deposits and flow and and of credit from smaller financial institutions to entrepreneurs that their businesses rely on to meet payroll, invest, and grow. So my first question, Mr. Furlow, in the event of a bank failure, how could the proposed two-step approach protect the deposits of community and regional banks?
Well, first, Mr. Chairman, thank you for the question. Great to see you. The first and most important thing is that we can act with speed. With the ETAG proposal that we are proposing, quickly ETAG could be put into place, and so you wouldn't have doubts about the security of deposits in a community bank or a mid-size or a regional bank. So that's number one. We have to remember that most of our small businesses in this country bank with community banks. It's back to the relationship discussion that we heard from Mr. Ryan, Ms. Castilla. So that's number one, is that we have to do that with speed. The second piece is to make sure we have fairness. Fairness is terribly important because as we saw in 2023, some of the larger institutions did see inflows of deposits away from our community banks. And why? Because the government couldn't say that community banks were going to get the coverage, even though they paid into the deposit insurance system.
Deposit insurance plays a crucial role in maintaining public confidence, especially for smaller and regional banks. However, as we evaluate potential changes, it's important that we carefully assess the full impact. So we know that more than 99% of deposits are already insured under the current limit, yet we lack in-depth data on how many businesses or personal accounts would be affected by raising that limit. So Ms. Castilla, can you speak to the risk of expanding deposit insurance limits without first having accurate data on how many accounts would be impacted, and what would that mean for the deposit insurance fund?
Thank you, sir, for that question. Acting FDIC chair talked about this in his testimony, how difficult it is to estimate not only the current accounts that might be eligible for this expanded coverage, but how accounts would shift into these new into the non-interest bearing accounts, especially if, I would work around this to game it as much as possible, just like my other banks would. If you do so legally, you're going to do so in a way to take full advantage of these opportunities for your customers. So I think you would see a huge movement into these insured accounts that could really expose the DIF to much more potential exposure than what we estimate it to be, and we would already be on the hook for those costs, whether it was a bank failure that occurs at the time and there's a skinnier DIF that's available for them, or that we're having to ramp up costs over that 10-year period.
Okay. In my final question, any discussion about deposit insurance must also discuss the failed bank resolution framework, given that any increase in deposit insurance will increase costs to the deposit insurance fund in the event of a bank failure. So those costs will, of course, be paid for by banks through higher insurance assessments, and in the worst-case scenario could require a backstop from taxpayers. So, Mr. Furlow, can you tell us about the complex interaction between deposit insurance and bank resolution, and tell us whether you think that that in order to address reforms to one, we must address reforms to the other?
Sir, this is all tied together. At the end of the day, our banks are paying premiums into the deposit insurance fund. And I'd mentioned earlier that we have to have certainty to this process, whether that is the bank resolution process or whether what will happen in a systemic emergency. So we have to address this in a comprehensive way. If we just do it as a one-off here and there on each piece, then we're putting various segments and the entire system potentially at risk with these gaps. And so that's why it makes sense under our two-step proposal to make sure that we have a systemic backstop in place so we have the time to address all of these very complex issues.
Okay, thank you. And Mr. Chairman, I ask unanimous consent to enter into the record a statement from Stephen Moore, founder of Club for Growth and Unleash Prosperity, raising concerns with who stands to benefit from expanded deposit insurance and who will bear the cost.
That will be included in the record without
objection.
objection.
With that, I yield my time back.
Gentleman yields back. We'll now hear from the gentlewoman from Texas, Ms. Garcia. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you to all the witnesses for joining us today. I think we all remember well, and some of us have talked about it already, the Silicon Valley Bank, Signature Bank, and First Republic Bank when they all failed. And as everyone has already referenced, emergency measures were taken, including the provision of deposit insurance for all depositors to prevent contagion to other banks. ensuring the depositors was high priority. Since the crisis, there has been a bipartisan understanding that federal deposit insurance does indeed need to be modernized. So let's get something done. I think we can do it. And I want to start my questions today with my fellow Texan on the panel, Mr. Christopher Furlow. In your remarks, you talked about a two-step proposal. The first step being to authorize an emergency transaction account guarantee, or ETAG. I found that interesting that it's called ETAG because that's the tax system to go through the Texas toll road. The ETAG program is also something that is talked about in Representative Waters, the ranking member's reform bill, which includes a provision which would allow regulators to temporarily establish a program for 6 to 9 months. Any further extension would require congressional approval. In your testimony, you recommend 120 days, which is 4 months, before needing congressional approval. Do you think that 120 days is enough time to preserve confidence and to mitigate any systematic instability?
Well, I think if you look at the 2023 failure, the reason things were extended, the crisis was extended because there was so much uncertainty. If we have ETAG in place, we can stave off the runs that continue things to be destabilized. And so 120 days will do a couple of things. One, it will bring calm to the system. If folks know that their deposits are safe, regardless of the size of institution that they choose to bank, that will bring calm to the system. Number two, 120 days will give us a full post-event quarter's worth of data. And as y'all know, that's always been a huge problem with the discussion of deposit insurance forms, the lack of data. We saw that in the Senate discussions earlier this year. We continue to talk about it here today. That would give us a full quarter's worth of data in that situation to determine what we're actually seeing. That would inform you here in the Congress, it would inform regulators, and it would inform the administration about the next steps that they can take. And so that's why we say 120 days. And then if you in the Congress determine that we need to extend that, you can absolutely do that.
But so do you just think that the 6 to 9 months is just too long? I'm trying to see what the real difference is here.
I do just think at the end of the day, if we're able to keep any type of event from being extended, 120 days should be sufficient, and especially if we're getting data, which we don't get today. So I understand why we've talked about maybe extending that longer, but we think, when we're addressing moral hazard by keeping it to 120 days.
Let me just move on then. So in the second part of your two-step, and maybe you should just call it the Texas two-step, is to modernize the federal deposit insurance structure to reflect the 21st century banking landscape. Could you expand on that? What exactly do you mean?
Well, we've talked about a lot of those things today, the bank resolution process and how that will work. When I look at our current landscape in deposit insurance, it's far beyond the simple allocation of what assessments might have to be, what the thresholds might have to be. And so this is a all-consuming type of issue that we need to explore comprehensively and not do this in a piecemeal fashion.
Right. Mr. Anderson, I wanted to ask you about community banks. In your opinion, would expanding deposit insurance promote depositor confidence in our community banks?
Yes, I believe so. I think an increase in deposit insurance limits, particularly one that's equitable and applies a level playing field across the industry, will increase confidence in depositors, not just in community banks, but across the banking system.
So what do you think about the Texas two-step that he's talking about?
I agree with the first step. My suggestion would be to rely on the time window that's in Ranking Member Waters' bill. The events of 2023, if you look at the calendar, First Republic failed on May 1st, and Silicon Valley Bank failed on March 10th, but there were still stresses in the system beyond the failure of First Republic. So if you do exercise a tag program to ensure to cover all transactional accounts, it probably makes sense to have a 6-month period with the potential extension to 9 months.
Okay, thank you, and I see my time has run out. I yield back.
Gentlewoman yields back. Gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman Hill and Ranking Member Waters, for holding this important hearing, and thank you to all of our witnesses for taking time to be with us today. Mr. Anderson, you've reviewed the call reports and the deposit data. Tell me, did deposits migrate from smaller banks to larger banks in the spring of 2023?
Yes, I think the regulators, the post-mortem reports reflected that.
And did deposits also migrate to government money market funds and elsewhere?
Yes, I believe so.
Thank you. Mr. Ryan, some have alleged that expanding deposit insurance coverage could increase moral hazard. What do you make of that argument? And as a bank executive, would higher coverage for non-interest-bearing transaction accounts compel you to take more risks?
Clients keeping more money in their non-interest-bearing business accounts are not going to increase risk for Old National Bank. And I believe protecting depositors does not create a moral hazard in this situation. People do not put excess funds in non-interest-bearing accounts. They do that very thoughtfully, and they only do that for operating purposes.
Thank you. And Mr. Ryan, I'm focused on the needs of Tennessee banks and credit unions in my home district. Some have suggested reciprocal deposits reform as a way to address flaws in the current system. Would adjusting reciprocal deposits be enough to meet the needs of Tennessee banks?
I do not believe so. I think we're just creating potentially another problem. Concentrating risk within those reciprocal networks or other private insurance programs creates a whole new set of unknown risk and unnecessarily complicates business owners' understanding of what insurance looks like.
Thank you. Mr. Anderson, given how rapidly rumors can spread on social media and trigger depositor panic, how well is the current $250,000 FDIC insurance limit equipped to contain the risk of a social media-driven bank run? And would raising the coverage limit provide a stronger stabilizing effect on depositor behavior in such fast-moving scenarios?
Great question, Congressman. I think if you look to the original intent of deposit insurance, it didn't take into account the social media and the speed of communication today. So I don't necessarily believe that the deposit insurance threshold, whether it's $250,000 or another limit, will kind of tame contagion through communication, just how quickly information spreads, and because of the technological capabilities we have today and the speed of money movement.
Thank you. Mr. Anderson, in what ways could temporary emergency programs like a modified version of the Transaction Account Guarantee Program in 2008 be designed to minimize market disruptions while providing short-term depositor confidence?
So I think an application of the TAG program helps to fill a gap within the existing financial regulatory response to a crisis framework. The systemic risk exception allows regulators to identify individual institutions to fully insure deposits, but the TAG program gets applied to the entire system. So if you had the opportunity to deploy the TAG program on March 12th after Silicon Valley Bank and Signature failed, then more likely than not, you don't have the failure of First Republic on May 1st.
Thank you. Appreciate the insight. Mr. Ryan, in your written testimony, you stated one MBCA bank helped a client spread a $10 million payroll deposit across more than 30 banks through a reciprocal network just to simulate coverage, fees, legal complexity, and stack of monthly statements. Could you explain on how situations like this illustrate the practical burdens and complexity that businesses face as a result of the current FDIC deposit insurance limits?
Well, the reciprocal networks in the best of times can act as a substitute. But what I would tell you is most of our businesses do not like that substitute. Less than 1% of our accounts choose to use that as a substitute. And it creates complexity and higher cost for both the owner of the business as well as the business of the bank. And I just don't think that is the best tool as a substitution for increased FDIC insurance limits.
Thank you. I appreciate that. I see my time's running out. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Illinois, Mr. Casson, is now recognized for 5 minutes. Thank you, Mr. Chair. Thanks to all our panelists here. Mr. Norquist, I'm used to seeing you at will on the Hill. I haven't seen your thespian side yet, but I always appreciate it. So I think some of my colleagues have mentioned that FDIC Vice Chair Hill recently said that the agency doesn't have the data on where the uninsured deposits are beyond, the very narrow $250,000 threshold. Mr. Furlow, you're nodding. I know you'd raised some similar points in your testimony, and it seems to me that there's two largely separate data questions. One is, what do we know about the deposits in banks that offer FDIC insurance but are beyond the insured threshold? And then separately, what do we know about deposits that are in banks that don't offer FDIC or other financial institutions that don't offer that? Do I understand your testimony, you're focused primarily on that first question?
That's right. We just don't have the data. I mean, that was, as you mentioned, that was in Vice Chair Hill's testimony. Chairman Scott on the Senate banking side also had requested that data. So this gap that we have in data is why we need a little more time to ensure that we can comprehensively.
So I guess just to that point, I'm a nerd. I'd like to see the data. I have some concerns that the FDIC has laid off about 20% of their staff in the last year. Do they have the horsepower to get that data, or do we need to be thinking about making sure that the FDIC has the resources to ask that question?
Well, I can only say this. You'd have to ask the FDIC if they have the tools for that, but we still need the data.
Well, anyone from the FDIC is watching and still employed, give a ring. Shifting to the deposits that are outside of the deposit insurance system, Mr. Anderson, there was a Treasury Department report in April that said that stablecoin adoption could result in $6.6 trillion with a T dollars of deposit outflows. Do you have concerns about the rise of stablecoins displacing traditional bank deposits?
Very good question, Congressman. If I could just touch on quickly the question about the FDIC and as well as your stablecoin point. But I think once a study is conducted, the FDIC should solicit input from the banking industry and other stakeholders. You can do this through an RFI or through a survey to get information and data around these types of accounts. How many are insured, how many are uninsured, and the size and the number of transaction accounts. With respect to your other question about stablecoins, yes, I do think that inviting additional risk into the system does expose future losses to the DIF.
But I guess I'm asking two questions. And one question is it pulling deposits out of the traditional banking system? Then the separate question is, where are those deposits going? We had introduced amendments to say that the stablecoin should only be able to invest those in insured accounts. Those amendments were rejected by my colleagues. So where is the money that the stablecoin issuers are taking in? Where's it ending up?
Yeah, that's a really good question that I don't have the best answer for you today, but I can get back to your office.
So if we were going to have a run on those uninsured deposits, do we know, like, where does that contagion sit in the banking system, or we just don't have the answer to that yet?
I don't have the answer to that today, and I'm not sure if others do as well.
Have any of you seen good data on that question?
I think the prevailing thoughts are those are going to be collateralized and they're going to sit with the nation's largest banks, not at mid-size or community bank levels.
Well, do keep in mind that USDC, one of the largest stablecoins, is only worth $1 today because we bailed out the uninsured deposits at Signature and SVB, right?
Right.
And we tried to close that barn door in the Genius Act and say these should be in insured accounts, and the barn door was jacked open. Are they in euro dollars? Right? Do they sit somewhere else? And going back to the first part of that question for you, Mr. Anderson, if those deposits are going out of banks, does that limit banks' ability to invest in the communities, the things we want banks to do?
Yeah, 100%.
Because the Genius Act doesn't you've got to put, as you just said, Mr. Ryan, those deposits have to go into things like treasuries and cash. They can't go into, let me help your small business get a working capital line so you can go and do some innovation.
Right. Every dollar uninsured or insured that is not in a depository institution is not able to be deployed by bank in the communities that they serve.
Yeah.
I do have a data point back on your previous question. The mid-sized bank surveyed its members, And a $10 million coverage, increase to $10 million covers 90+% of the account holders. So just a data point for you. It's a sample of about 100 banks.
Yeah. I yield back. I'm hearing the gavel. Thank you all. Let's get data and let's close barn doors.
The gentleman yields back. The gentleman from Pennsylvania, Mr. Muser, also the chair of the Subcommittee on Oversight and Investigations, is recognized for 5 minutes.
Well, I think I, for one time, agree with my colleague's final comment about data, so that makes it an interesting day already. So we're all here, you know, we have a sort of a saying here the chairman started, make community banks great again. We know the data where there's about 1,200 to 1,300 less community banks today than 10 years ago. A large portion of that was through consolidation, whether that's a good thing or not, that's what happened. So we've been at $250,000 in FDIC insurance since, 2010, with no inflation increases or anything. And, you know, you can't help but think, but loss of some of those community banks and all, there's less access to capital, more small businesses have difficulty gaining that access to capital. However, we here are talking about raising the 250 or not, or coming up with other solutions, but we want to avoid all of the unintended consequences, which is why I agree with my colleague about that, and why our chair, French Hill, wants to gain more data and full understanding so we avoid that. So all that being said, Mr. Ryan, do you believe the $10 million in deposit insurance coverage would help regional banks?
I believe it helps all community, mid-size, and regional banks.
Okay, all right, it helps. Consequences? Unintended?
I think you have to ask, is there a moral hazard here, which we do not believe. When you're talking about protecting America's small business, there is no moral hazard.
Okay, maybe. But that's what we're trying to figure out here, right? So do you think, Ms. Castilla, do you think that, how would they absorb the potential, the larger banks, the higher premiums associated with expanded coverage? I mean, Mr. Norquist suggested that higher costs, less lending. What's your thoughts on that?
Yeah, I'm not sure how it'll affect the large institutions, if they'll be able to absorb this fairly easy. But I also doubt that there'll be very much migration and liquidity from the larger institutions just because we increased to the 10 million.
Okay, so how would it affect your bank?
In my bank, we would ultimately start paying higher assessment fees. If there was a failure, I would have more exposure to special assessments. It would, I think, unlevel the playing field even further for regional banks to have more liquidity sources potentially to deploy to make it where it's, you know, it just continues to be uneven with small community banks.
You believe in the reciprocal deposits? That works out pretty well for you?
I've been using it for 20 years. I've never had an issue. We've gone through the financial crisis, we went through the SVB fiasco, and never had any kind of volatility there. My customers, and contrary to Mr. Ryan, are very astute when it comes to utilizing reciprocal networks. We have this integrated into their online banking systems. They are able to select which banks they want to exclude. They're able to do due diligence on these banks as if they were driving from lobby to lobby, opening $250,000 accounts. We find it as a strength and a way to really continue to enhance our relationship with the customer.
It does seem like a tactic to deal with the 250,000 FDIC.
Yes,
right?
so consortiums of banks easily could get together too, and they have to do the same thing. But it basically is a technology solution that makes it where the customer doesn't have to drive to bank,
right.
where we now have a technology platform where they're able to distribute their
Go ahead,
deposits.
Mr. Ryan, you want to say something?
Yes,
Quickly,
if you're a small business owner and you were used to receiving one bank statement and now you have to receive 30 bank statements as a result of using reciprocal networks, that's more complex. I would also add these conversations work during normal periods of time, but in times of crisis, it's really hard to explain how reciprocal networks work.
I'll just say that we do consolidate our statements to one statement for our customers.
Okay, I can understand both your positions. Mr. Furlow, will the banks, what's your position real quick, and I want to get to Mr. Norquist, on the reciprocal, because you view a lot of banks, and were your community banks in jeopardy during the SVB crisis?
During the SVB crisis, you know, we've got a lot of community banks where they have large depositors. We have a huge oil and gas industry, for example, in the state of Texas, and you have large depositors in community banks, and their lending capability is impacted when you see an outflow. So again, our proposal on ETAG to make sure we have a backstop on the front end to stop those outflows right from the get-go is terribly important.
Thank you. Mr. Norquist, what's the solution here?
Well, not to go deeper, I mean, when we went up to 100,000, things didn't get better, they got worse. And in the past, we should open the door more to private sector insurance. This works in many, many industries. You know, we deal with everything from floods to hurricanes with insurance. Banks can make the same
We'll have to
decisions.
talk offline. Apologies, my time is over. I yield back, Mr. Chairman.
The gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Mr. Chair. One vital institution keeping our communities afloat and helping everyday people build wealth and stability are community development financial institutions, or CDFIs. Now, people at home may not know them as CDFIs, but they are the local credit unions with consumer-friendly interest rates, the affordable housing nonprofits with units that you can actually still afford, and the lenders keeping the community health centers in your neighborhood thriving. There are dozens of CDFI branches in Massachusetts serving communities in need that received over $400 million from the CDFI fund. Now, these funds finance nearly 600 affordable housing units. We all know there's an affordability crisis in the country, and we certainly see that play out when it comes to housing. And housing is certainly much more than shelter. You know, it is dignity, it is health, it's refuge, it's social and economic mobility. So that's 600 families with a safe place for kids to study, for parents to rest after a long day at work. So we should be celebrating our CDFIs. We should not be attacking them. But the Trump administration is trying to illegally fire the entire agency to stop this essential work. It's my hope that in today's hearing we can find ways to improve deposit insurance coverage for these community-centered institutions. Mr. Anderson, some depositors have expressed concerns that their money won't be as safe in a smaller bank. These misconceptions are dangerous and contributed to the depositor run we saw in the Silicon Valley Bank failure in 2023. Can you explain why CDFIs and also why minority deposit institutions, or MDIs, are safe and reliable?
Thank you for your question, Congresswoman. I think MDIs and CDFIs are vital to our nation's economy. Community banks in general serve as engines for economic growth in the neighborhoods and in the towns and in the cities that they serve, both in rural America and in cities. I think it's equally important for us to have a diverse, dynamic financial system that has small banks, mid-size and regional banks, and GSIBs. It's in our broader national interest for us to have institutions that can serve various types of borrowers and customers, and are positioned to make offerings of products and services to all different types of corporate entities and people.
Thank you, Mr. Anderson. Mr. Ryan, could you expound, building on that point by Mr. Anderson, about if we were to increase the deposit coverage, it's not just beneficial to urban communities, but how does this help rural communities better navigate a crisis? Could you speak to that?
Yeah. Old National serves many rural communities, and they are the lifeblood of America, I believe, and it's important to be able to support all of those institutions that are in there, including CDFIs and MDIs. In fact, we're in the process, as I stated earlier, of helping create a new MDI for the state of Indiana that's really going to reach out to those communities and help with those projects like low-income housing and other affordability needs. I think it's paramount to have higher insurance limits to help these smaller institutions not only survive, but actually thrive.
Thank you so much. And Mr. Anderson, how do, for the folks watching at home, how do everyday people not connected to these banks benefit indirectly by improved depositor confidence?
I think depositor confidence is a vital component to the trust in the broader financial system. When you have small banks in Oklahoma that fail, or you have Washington Mutual that fails, it threatens people's confidence and their faith in the financial system. So it's incumbent on this body and on regulators to ensure that our banks are safe and sound, and that our financial system is strong and resilient, and we have a framework that resolves institutions that fail through an orderly and rapidly process.
Thank you. So I represent the Massachusetts 7th Congressional District, and CDFIs in my district include organizations like the Boston Impact Initiative, Dorchester Bay Neighborhood Loan Fund, and of course the largest Black-owned bank in the country, One United, I'll call the MA7th their home. And they provide housing, childcare, and healthcare facilities, affordable, healthy food, and banking, and wealth-building opportunities to consumers as well as to entrepreneurs, truly an essential role. Now, while Republicans in the Trump administration are working actively to dismantle the CDFI fund, Democrats are fighting to protect it. If my colleagues across the aisle were serious about lowering costs and growing our economy, they would stop attacking CDFIs. Continued federal funding and deposit insurance reforms that protect CDFIs are essential and will help our nation's economy thrive. Thank you.
The gentlewoman yields back. I now recognize myself for 5 minutes for the purpose of asking questions. We're all concerned about the resiliency and strength of our banking system. I want to ask a few technical questions, if I can, as it relates to the proposal and the effects of it. Start with you, if I can, Mr. Ryan. Obviously, many companies are sweeping their cash in interest-bearing accounts and only move it back into non-interest-bearing accounts as they pay expenses. As this impacts non-interest-bearing accounts, as it moves into interest-bearing accounts, how would that impact the proposal from the Senate?
Well, the proposal from the Senate is really centered around non-interest-bearing business accounts.
So as they sweep it into an interest-bearing account, would it?
That would not be covered under, I think, this proposal.
And is that what the vast majority of businesses do?
I think only the largest businesses utilize those sweep functions that have those excess investment dollars. So really, most of our small business accounts leave them in their operating accounts.
Thank you very much. Let me continue on with you if I can. Currently, the data the banks report on transactions on nonpartisan or non-transaction accounts of the FDIC combines individual business partnerships and corporations together. Then banks combine all those types of accounts and account holders together when they report on their insured and uninsured deposits. And actually, let me start with you, Mr. Furlow, on this. I'll let you comment on this as well, Mr. Ryan, if I can. Do you think the current data the FDIC has is sufficient to enact any of the proposals that we're talking about?
I think we've got more work to do. Again, I think that's been addressed on the Senate side and through the hearing here today. We need more data.
And so you would need more data so the banks would have a new reporting requirement? Or we would need to put one in place. Is that an accurate statement?
If we need to collect the data, correct.
But you're saying we would need to, off the first question. Is that accurate?
I'm sorry, I don't understand the question.
You would need to collect the data to implement the proposal.
Which proposal?
The proposal from the Senate, the Haggerty.
From the Senate proposal. I would assume that you would have to do that. Again, this is the biggest question that we have is why are we setting thresholds at certain places?
But not even getting into the threshold amount. I'm just talking about the burden. Maybe I can come to you, Mr. Ryan. Does that place a new and additional burden on the banks?
I think it's a relatively small burden to overcome. We deal with call report changes routinely, and collecting this data and providing it to the government regulators is not a heavy burden for most financial institutions.
Go ahead, Ms. Castilla.
Small banks currently don't report this data in the call report, so it would be a completely different framework for the nation's 4,000 community banks.
And how much of a burden would that be?
Incredible. These are manually calculated numbers. And
Give me a rough estimate of what that would look like if it had a community bank that's in Wisconsin. How many hours of work or investment?
I mean, technology would be over $100,000 most likely annually to be able to upgrade our technology to be able to compute this type of data. In man hours, I have 70 people. I probably would have to add a half a person, another person to be able to handle the data analytics.
Thanks. That helps frame what that would look like for us. Give you an opportunity, Mr. Furlow. We talked about the valuation. Why this valuation? Why not a different one?
Well, I think that's the question that we have. Unfortunately, we have folks who have different positions on this issue because we don't, why 20 million, why 10 million? Those questions are still out there. I can tell you that my association is open to different proposals, but where you draw the line on those, it will impact the cost. Who pays? These are all things that are still out there, and why data collection is so important, more broadly, not just in the framework that you just mentioned with Ms. Castilla.
Thank you very much. I want to come to you, Mr. Norquist, if I can. I think you and I always start from a place of the private sector is better to regulate than the federal government. The federal government's a backstop if the private sector is incapable of doing the job. As we think about this broader space, how would this proposal impact private sector innovation that could otherwise come online?
Well, it's being put forward instead of opening up to private sector innovation, particularly in questions of insurance. We should be making it easier for banks to get insurance and get the government out of some of the regulations, some of which you guys did in taking part of in some of the reforms from 2001? Pardon? 2018, I'm sorry, I wasn't remember the date. But we took some of the Dodd-Frank mistakes out and opened up for more opportunities. So I think you just need more alternatives instead of one single government program.
Cognizant of the time, thank you.
Yeah.
Thank you for that comment and getting it on the record. I'll yield back. I'll now recognize the gentlewoman from Michigan, Ms. Talib, for 5 minutes.
Thank you so much. I think it was Mr. Ryan that said in the wake of the 2023 regional bank crisis, I'm not sure, maybe Mr. Anderson, you can confirm, we saw that during that crisis, small businesses and other depositories moved their money from smaller institutions to the mega banks. Is that correct, Mr. Anderson?
Deposits did move up to larger banks, but I think it's unclear whether those were
Okay, well, I think
businesses
people assume
or-
that the government will swoop in and bail out the big banks, because we did it before. Since if they fail, they might take the rest of the financial system down, right? So we come in and swoop in and bail them out. My residents still talk about the bailout. So people count on this implicit government support for the mega banks. And they see them as a safer bet because the government can come in and swoop in and save them, correct? Nobody wants to admit that. It did happen, actually. Okay. When we see deposit inflows to the mega banks, doesn't this only worsen the already massive consolidation we've seen in banking sector in recent decades, Mr. Anderson?
I think that there is a move to consolidation amongst the banking industry as our numbers of depository institutions in the U.S. continue to decline because of bank mergers.
Okay. Do you think, isn't deposit insurance expansion essentially if community banks and credit unions are to compete with the biggest banks?
I think the potential increase in deposit insurance adds a benefit to customers by virtue of them leveraging these non-interest-bearing transaction accounts.
Well, one proposal for a fairer system would folks are proposing having largest banks pre-fund the orderly liquidation fund. And then they'd have to pay an upfront fee for, let's be honest, the implicit government subsidy that's there to protect them. So, Mr. Anderson, what is an OLF and why do we have pre-funded deposit insurance? Pretend our parents are watching and you have to explain this to them.
Yeah, so my general sense is that the Depository Institution Fund serves a unique purpose in serving as a backstop for all depositors. I think the proposals in the Senate currently that isolate the large banks should take an approach where it's an equitable, level playing field so that...
So we're telling mom and dad at home that we're isolating the big banks from having to pre-fund this, correct?
Yeah, I think the ultimate impact on doing that is on the customer because we don't want to disadvantage certain small and medium-sized businesses from choosing a community bank over choosing a large bank. If the intent of the legislation is to provide protections for those customers, we should do it regardless of where they choose to bank.
Gotcha. Let's turn into another type of uninsured deposit, stablecoins. Stablecoin issuers are basically banks. They really are shadow banks. but stablecoins are not backed by deposit insurance. With the passage of the Genius Act, crypto exchanges can now offer customers so-called, quote, rewards that look very much like interest paid by a bank. So, Mr. Anderson, when people can earn interest-like rewards on their stablecoins, doesn't that incentivize the expansion of what is basically uninsured deposits?
I'm not sure if I have a good answer to that question today.
It's a yes. You'll see. Mr. Anderson, isn't this potentially destabilizing our regulated banking system right now by diverting deposits from banks into stablecoins?
I think it's less than optimistic to take deposits from banks and put them outside of the regulated financial system, in large part because banks aren't able to lend with those deposits.
So, last question. Are there any other uninsured deposit equivalents issued by shadow banks that we should be concerned about?
Not that I know of.
Okay, thank you. I yield.
The gentlewoman yields back.
I'd ask unanimous consent to submit statements for the record from various trade groups who have either endorsed my deposit insurance reform bill or otherwise urge our committee to take bipartisan action, including Community Development Bankers Association, representing CDFI banks, Mid-Side Bank Coalition of America, that is MBCA, Independent Community Bankers of Association, American Bankers Association, America's Credit Unions, and prior testimony from National Bankers Association, who also endorsed my bill.
Without objection. The gentlewoman from California, Ms. Kim, is now recognized for 5 minutes.
Thank you, Chairman and Ranking Member, for hosting today's hearing, and I want to thank all the witnesses for joining us today. You know, I'm the only California and Western State Republican on this House Financial Services Committee, so the crisis at the Silicon Valley Bank was extremely concerning. This is the first year of my second term when I was assigned to serve on this committee. We had to deal with that. So in the following months, I reached out to the banks in my district, and I worked on legislation and letters targeted at bringing some stability to the banking system and transparency as to the decision-making process that was made by the Biden administration's regulators. And as we evaluate numerous potential solutions, it is important that we carefully think through each of them rather than rushing for a quick fix. Right? So I want to ask you a question, Mr. Ryan. During the Silicon Valley Bank crisis, did your bank receive any deposit inflows or new account openings?
We did receive some new deposits during that time frame. There were certainly lots of discussions being had by many business owners. We also lost some deposits to some of the large institutions. Some of those boards of directors, whether it be nonprofits or for-profit, felt like they had a fiduciary obligation, and they felt like there was a perceived safety in moving money to the largest institutions.
That goes to the question I wanted to ask, you did have some conversation with your colleagues, and when you and your colleagues asked potential depositors as to why they chose larger banks over banks like yours, how often was that reason related to deposit insurance coverage limits?
That was the primary reason they were moving deposits, were the perceived safety of being at a larger institution.
Mm-hmm. You know, I heard a lot about how globally significant banks received an increase in deposit inflow during that 2023 crisis. However, I'm curious as to what deposit movement looked like across different bank sizes and how much of it remained within the community and the mid-size bank range. So let me ask you, Ms. Castilla, I know that in the case of your bank, Citizens Bank of Edmond, you were actually opening new accounts during the 2023 that crisis, right? So can you tell us, when you discuss with your depositors as to why they were attracted to Citizens Bank, what were the reasons they gave you for wanting to open accounts with your bank?
Thank you for that question, ma'am. We were very transparent and in front of the communications, sharing non-public information with both our customers and the public in general. So we had current customers moving accounts to us, and we also had inquiries around the nation of banks, of consumers and businesses wanting to bank with us. We actually had a technology provider provide us a discounted account opening solution so that nationally individuals could open accounts at Citizens Bank of Edmond because we were seen as such a trusted source during that time of crisis.
Well, it's clear that your leadership at the Citizen Bank made a clear difference. So thank you for that. And I want to commend you for the national standard that you set during that difficult time. So let's look at some of the potential solutions that's attached to today's hearing regarding collateralization, custodial deposit, reciprocal deposit reform. Is it possible to combine those potential solutions with an increase in deposit insurance as well?
Well, ma'am, I just don't see with those solutions that a deposit insurance increase is needed because I have more than enough availability with reciprocal deposits. I can get hundreds of millions of deposit insurance accessibility to individual customers. So it's a very safe network that's integrated into our solutions that it really can create a competitive advantage over larger institutions in our area.
You know, one potential solution that I have to reform community banking is the Community Banking Lift Act. And this bill will reduce the community bank leverage ratio to from 9% to at least 8% or even lower, right? So, Ms. Castilla, how do you see the Community Bank Lift Act as helping the community bank ecosystem and potentially preventing future bank failures?
Yes, ma'am. Thank you for that question. I don't know a lot about the specific act, but the community bank leverage ratio, reducing that will allow us to deploy more of our funds into our community. We currently today are selling 30 million of our deposits, about 10% of our asset size, to one-way sell because my current community bank leverage ratio number is so high, I can't deploy them locally. Risk-weighted assets are also putative for small banks, and so that's another way to consider as well.
Thank you. I yield back.
Gentleman yields back. The gentleman from California, Mr. Liccardo, is now recognized for 5 minutes.
Thank you, Mr. Chair. Appreciate the testimony of our witnesses today. I think I'm coming around to the view that we very certainly need better data, certainly about the depository inventory that many banks have, understand what percentage is insured and uninsured, and it seems to vary quite a bit by size and type of bank. And I also appreciate the need for a permanent tag program. As Mr. Furlow suggested, I think Ranking Member Waters has a good bill on this, and I look forward to seeing how we can create a tag program that doesn't require congressional authorization to be activated. I guess I just want to focus on this issue about a targeted increase in the FDI. And I appreciate that this question of moral hazard comes up, and the logical answer to respond to how do we mitigate moral hazard is let's try to limit this to non-interest-bearing accounts. I think, Mrs. Castilla, both in your statements as well as your written remarks, you allude to the fact there are other ways of compensating depositors. And I think you mentioned inflated yields on linked accounts, sweep accounts, rebates, rewards checking, loan discounts, service credits, toasters, tickets to Bad Bunny concerts, whatever it might be. We know that there could be ways of incentivizing folks to try to take advantage of this much higher limit. And I guess I'm trying to understand from those who advocate lifting the cap in some way, even on a targeted basis, how do we prevent banks from engaging in that kind of activity that would encourage a rush to the more insured deposits? Any thoughts? Yes, sir.
I don't see that as a risk today. I think the vast majority of banks operate, where we do have multiple deposit accounts for relationships. I don't see that increasing the limit creates a new set of risks that we can't anticipate in terms of linking these accounts together and using other incentives. It certainly doesn't happen at Old National Bank today, and I'm very familiar with all the mid-sized banks, and I don't see that as an issue either.
Ignoring seems like a strange defense to that type of situation. So I think that there would have to be additional policing and regulation and oversight if you're introducing restrictions related to this type of account. And I don't think any of us really want that.
I agree that defining the type of account through regulation is critical, so we don't have a gaming. So I agree with Ms. Castilla. But I also think that it's important to understand that banking relationships are very sticky, right? If you run an auto body shop or a nail salon or a dry cleaning service, your choice of bank is probably going to be decided based on the locality of the bank in proximity to your home or to your business. So there's a pretty defined universe of institutions for the types of customers we're talking about. We're not talking about John Deere and Amazon and Home Depot that have global multinational businesses, but for those small and medium-sized enterprises, the 501c3s, the religious organizations will generally bank local, and those deposits within those institutions are going to be pretty sticky.
Thank you, Garrison. I appreciate the point. As we're thinking about this, really we're talking about who pays. Ultimately, there are transactional costs involved. There are market-based solutions to address uninsured deposits, and we've talked about what those are. You know, FHLB, letters of credit, private insurance, reciprocal deposits, broker deposits, et cetera. Those impose costs. We know on transaction fees, I think Ms. Castilla referred to 12.5 basis points on reciprocal deposits. Now, if we look at the alternative here, one alternative, which is the increase in FDI, then there are clearly fees that have to be paid. Is there any way we can get our arms around? Is there any data out there, any studies to help us understand in the aggregate, are we stuck with more costs under the current system or under a regime in which we are lifting FDI and imposing these fees on banks?
I can speak to the mid-sized bank perspective on this. You know, we believe even if there's a modest increase in the insurance costs, and we estimate that could be somewhere between 2 to 5 basis points, the alternative is we have to go to national markets or wholesale markets or brokered CD markets and raise money at 25 to 50 basis points. So we go from 2 to 5 basis points for additional insurance costs up to 25 to 50 basis points. And I just want to make one quick point on your last question. 40% of the deposits are held by the nation's largest, the GSIBs institutions, and we assume those are all fully insured.
The gentleman's time has expired.
Thank you.
Further comment can be provided for the record. The gentleman yields back. The gentleman from Nebraska, Mr. Flood, who's also the chair of the Housing and Insurance Subcommittee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Before I start my questions, I've got to compliment Mrs. Castilla. Back in 2019, I was trying to remodel the downtown of Norfolk, Nebraska, and I looked at who in the nation had done the best job with their downtown. And this community banker from Edmond, Oklahoma, hosted me for the better part of a day. No idea we'd ever be doing this. She was gracious with her time. She's not just a community banker, she's a community advocate, and we can all be very proud of what she's accomplished. And so it's nice to see you this morning. With that, let me begin my questions. We all remember the uncertainty right after SVB failed and First Republic Bank. Thankfully, we were able to avoid the worst possible outcomes during that time of instability. And I really credit both the Republicans and the Democrats on this committee. I remember a phone call with the Treasury Secretary, our former Chair McHenry, obviously our Vice Chair at that time, Mr. French Hill, our Ranking Member, Maxine Waters. There was a lot of uncertainty, and we stuck together as a nation to prevent a contagion from infecting our entire financial system, and it gave me a lot of confidence that Congress can take on tough problems. So in the lead up to those bank failures, there were lots of deposit flows, specifically from the troubled institutions like Silicon Valley Bank and First Republic. This makes sense when depositors start getting concerned that an institution is in poor financial health. They often pull their money. But our conversation today contemplates broad, sweeping changes to deposit insurance that will have implications that will affect all institutions. In order to justify a particularly large increase in deposit insurance, especially for just one type of account, non-interest bearing, I'd be interested in a better understanding of how deposit flows have been moving over the last several years. First question, if you could be brief in your responses, This is for all of you. Aside from deposits that left the specific institutions that failed in 2023, have you seen evidence of further deposit flows from other institutions toward the perceived safety of a GSIB bank or a government money market fund? We'll start with you, Mr. Ryan.
I would say the long-term trends are to take money out of non-interest-bearing accounts and move them in interest-bearing accounts. And we've also seen long-term trends where the biggest banks are only getting bigger. And you might call that around, maybe it's a product or technology issue, or maybe it's a perceived safety issue. But the long-term trends are clear. The bigger banks only are getting bigger.
Thank you, Mrs. Castilla.
So good to see you again, sir. Our core deposits have grown 26% since the Silicon Valley Bank failure. We have 0 broker deposits, 0 listing services deposits. I only have $5 million of long-term loans from Federal Home Loan Bank. We are selling $30 million in deposits I would love to deploy in my community, and we've seen the growth be very substantial and strong.
Thank you. Mr. Furlow?
Our community banks in the state of Texas manage very well the ebbs and flows of the economy, but when these systemic types of issues, COVID and certainly the SVB crisis, occur, we have absolutely seen outflows from our community and mid-sized banks into the largest of institutions.
Mr. Norquist, you want to provide a perspective?
What they said.
Okay.
I think it's well evidenced that there were outflows from mid-sized and regional banks to the larger GSIBs during the banking stress of 2023, but I think that was somewhat isolated, and I don't think it's carried on beyond that stress event.
Okay, so maybe this is more for Mrs. Castilla and Mr. Ryan. Are you sensing some anxiety among some of your larger depositors? Are they thinking like, okay, I've got my payroll account at a bank in Edmond or a bank of yours, Mr. Ryan, in Texas? Are they thinking about that? Are they expressing anxiety? Are they asking questions about the special insurance you can buy that they pay for over and above?
We use very little deposits in the reciprocal networks. I think in periods of stability, they are not asking those questions. It's only in periods of time where there's great instability and great uncertainty, I think those questions get asked. We win because we have closer relationships in our communities than the large institutions.
Sir, we don't wait for them to ask us questions. We offer them the solutions when we see that they're exposed with uninsured deposits, and our tellers, our personal bankers, all are very well equipped to talk about reciprocal deposits and how customers, whether it's through account structuring or using the reciprocal system, can maximize their insurance coverage.
Well, I'll tell you what I like about this hearing is I like the idea that we're talking about these regionals and these community banks. I don't want to live in Europe with 1 or 2 banks in a country. I want to live in a world where we have state chartered banks, we have federal chartered banks, where we have community banks, regionals, and GSIBs. That's the magic of our financial system. And so while we may disagree on a path, let's stay focused on making sure we can maintain our diversity. With that, I yield back.
The gentleman yields. Without objection, I am entering into the record a letter from 11 conservative groups raising opposition to increasing FDIC deposit insurance limits for non-interest-bearing transaction accounts. The gentleman from Texas, Mr. Green, who is the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and I thank the ranking member, and I'm grateful that we're having this hearing. I think it's exceedingly important. Let me start with an expression of posting H.R. 3716, the Systemic Risk Authority Transparency Act. I think this is an important piece of legislation because it will allow us to have timelines similar to those that we had after the failure of some significant institutions. Having said that, Mr. Ryan, you do believe that we should raise the FDIC limit, is this correct?
Correct.
And have you announced a number?
Well, we've done some surveying of mid-sized banks across the country, and we believe the number of around $10 million would cover 90% of those total accounts. If we raise the number to $20 million, for example, we pick up about another 5% to 95%.
And you would differ with Mr. Norquist, I take it. Mr. Norquist seems to think that this can be handled by the private sector.
I think that's concentrating risk in unknown sets of entities, whether it's reciprocal networks or private insurance. I think that creates a whole new set of risks that we have not quite evaluated yet.
And Ms. Castilla, it seems that you're okay with raising, but you're not sure that it's the proper thing to do right now. I'm not sure that I've characterized your position appropriately, so if I have mischaracterized, would you please help me?
Thank you, sir. I believe that any change should be data-driven and that we should look at what the data is telling us and then let that drive policy. Right now, when I look at my customer base, I'm able to use market tools right now to cover just about any deposit that walks in my door. And utilize reciprocal networks, pledging securities, or using a letter of credit from the Federal Home Loan Bank. I can take care of any customer. I also pay them interest. And so for me, I would not be moving my customers to non-interest-bearing accounts. I view myself as a trusted advisor. We're in an interest rate scenario right now where interest rates are higher. So when a nonprofit comes to me and they've got $1 million, I'm going to counsel them on earning interest on that.
I'm going to have to move on.
Yes,
Thank
sir.
you. Mr. Furlow?
Yes, sir. Thank you, Congressman,
From
for the question.
Texas.
Yes, sir. Looking at what we did as we put together our ETAG proposal and our two-step proposal was to go back to 2023 and deconstruct what was literally happening at that time. And I think you may recall, everyone was asking the question, do we need more than $250,000 in coverage and raise that limit? We were talking about maybe $500,000, $750,000, $1 million. The highest number I heard during that time frame was $2 million. So the question that then becomes is, well, where is the right threshold? And I don't know that we know the answer to that, which is why, again, we're proposing the ETAG proposal, which is a two-step process. Let's get a backstop in place so we can figure out where the threshold is and where we can set essentially a fair threshold for banks of every size.
I think I have your point. Let me move on. Mr. Norquist, no disrespect, but I know your position, so I'll move to the next person if you don't mind. Sir, your position, please.
Yeah, I think a change to the regulatory framework for deposit insurance is incredibly important to study, and it should be empirically based, whatever the threshold amount is. Today, we only have a single system of deposit insurance for a handful of different account types at $250,000, but the conversation we're having now is a separate classification of non-interest-bearing transactional accounts, and I think that...
Let me do this because time is limited and I've got 50 seconds. Permit me to ask you, Mr. Anderson, do you think that this can be accomplished with the process that Ms. Waters has proposed? Because in the rulemaking process, you do acquire empirical evidence before you make the rule.
I think the proposal that Ranking Member Waters has put forward is incredibly thoughtful, and I think there are components of it that should be applied directly. I think the emphasis on a study and ultimately allowing the FDIC, who hasn't yet weighed in on this debate, to provide a critical recommendation on what a potential increase for these non-interest-bearing transaction accounts would look like.
Well, thank you. I am supportive of the legislation proposed by Ms. Waters. I'm hopeful that we can move this legislation. There are many community banks that do believe they need a higher limit to attract business customers. Thank you very much. I yield back.
The gentleman yields. The gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm glad that we're here having this discussion today because it's critical that we reflect upon the impacts of potential reforms. While the actions of the past few years certainly warrant this conversation and the search for possible systemic improvements, we must ensure we're acting with proper data and a thorough understanding when changing a system that, as it stands, is generally well capitalized and successfully in fully insuring over 99% of deposit accounts at U.S. financial institutions. Mrs. Castilla, when you are dealing with customers at a bank like yours, be they individuals, families, or businesses, I imagine there are merits to having uniform deposit insurance for everybody that is easy to understand. So if we do pursue some of the proposals that are out there that would change that, what do you think the consequences would be if it became a two-tier deposit insurance level based, or on whether or not the account holder is an individual, family, or business?
Yes, I believe this becomes quite confusing, both for the consumer, the business person, as well as the bank staff that's trying to stay up to speed to calculate real time what the deposit coverage is for particular accounts. There's so much complexity with how small businesses set up business accounts as well. It can be very difficult in our systems to be able to track that appropriately. Additionally, all of these, the reporting through our call report system is not adequate to be able to have this bifurcated system of having the non-interest bearing accounts covered. I fully support some type of indexed or as we analyze an overall look at deposit insurance to see if the adjustments need to be made.
Understood. Mr. Furlow, if we are going to consider proposals to target certain kinds of accounts with higher deposit insurance limits, we need to ask ourselves what the purpose of deposit insurance is and who we are seeking to provide extra insurance to. With less than 1% of insured deposit accounts over the current $250,000 limit, the overwhelming majority of Americans have 100% deposit insurance coverage. Can you tell us what kinds of deposit accounts you think policymakers should be targeting and why?
Well, again, when we looked at our proposal on ETAG, we went back to 2023. And it was those transaction accounts that we thought that we should look at, because that's primarily where the issue was at that time. So we deconstructed that event, and that's why we focus on the transaction accounts.
Mr. Norquist, same question.
Again, there are opportunities to have private insurance, and we should look at those. I think when we went from 40,000 up to 100,000 coverage, we had the disasters of the S&L. I'm not sure that increasing the moral hazard of guaranteeing some deposits is a good idea. I mean, it hasn't worked in the past. It's gotten less helpful.
Mr. Ryan, were we to target specific kinds of accounts with increased taxpayer-backed insurance coverage, there would be some pretty big incentives to mischaracterize the type of accounts you own to benefit from the higher coverage. Bank regulators would have to craft new regulations and reporting requirements to target coverage, and bank supervisors would then be tasked with a new duty of doing due diligence to be sure that no one was gaming the system. How would you address that?
Well, I would start with insurance is covered by the banking industry. These are the fees. These are not taxpayer-funded accounts. This is covered by our industry. And we have a whole host of accountants and regulators, and more regulators than I can count on one hand, that overlook our shoulders each and every day. So I think banks generally wake up every way and try to do the right thing, and then we have a whole host of people sitting around our circle ensuring we're doing the right thing.
Ms. Castilla, thoughts?
Yes, sir. I think that this is a really difficult policing job that we're going to be giving regulators. We don't want regulators looking over our shoulder every day to see if we're doing the right thing. And we certainly don't want to ignore if there's going to be transitions of utilizing the accounts inappropriately.
Appreciate it. Yield back the remainder of my time.
The gentleman yields. The gentleman from Tennessee, Mr. Ogles, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the panelists for being here. This is an important topic. I do think anything that we do should be data-driven. I'll quote Reagan, I think the scariest phrase in the English language is, "I'm from the government and I'm here to help." And I think sometimes we tend to overreact and overregulate and make a problem otherwise worse. So that being said, I think a cautious approach and trying to understand those unintended consequences are incredibly important. The goal of helping community banks is a laudable one, but an analysis is needed, to my point, to ensure any increase does, in fact, help community banks. And if the goal is indeed to support community banks, then the inclusion of regionals and super regionals is outside the scope and potentially counter to the goal. Ms. Castilla, I know you've answered this question, but I just want to emphasize, during the deposit flight of SVB, did you experience deposit flight?
I did not. I experienced deposit acquisition.
And then do you believe an increase in deposit insurance will help community banks?
It will help some that have exposures on non-interest-bearing accounts, but for most community banks, from what I hear from my peers, no, it will not.
And to kind of target something that you just said, the banks have exposure. That's a management issue, is it not?
That is, whenever we see high exposures to uninsured deposits, that is a decision to be made. There's plenty of marketplace tools to fully cover customers' exposure on if they're uninsured.
Ms. Castilla, staying with you, I want to ask about the potential for moral hazard this proposal could potentially create. You said in a recent op-ed that raising the coverage cap would invite moral hazard. You mentioned that such behavior would distort competition and weaken the discipline that deposit insurance is meant to preserve. Could you elaborate and explain that?
Yes, its current market tools exclude troubled financial institutions, those with CAMELS ratings 4 and 5. They care frozen in their participation from federal home loan bank letters of credit pledging, lines of credit, as well as any participation in the reciprocal deposits.
Yes, ma'am. Should community bank institutions like credit unions have a differentiated approach to premiums or oversight given their typically lower risk profiles and cooperative ownership structures?
I don't believe any differentiation between institutions. I think we need a standardized system throughout the economy.
And then coming right back at you.
Yes, sir.
In your experience as a community banker, do you regularly observe small businesses clients with deposit accounts in the range of 10 million? Do you regularly hear from small businesses that need 10 million in deposit coverage?
We have a large oil and gas industry in Oklahoma. There are fluctuations in accounts. We're able to use reciprocal deposits and sweeps so that they're able to earn interest whenever they have those large balances.
So you have a solution to the issue?
Yes, sir.
Mr. Norquist, in a recent op-ed in The Hill, hello, by the way, you said every dollar spent on premiums to the FDIC is a dollar not invested in economic growth. You stated that the estimated costs are huge. The FDIC would need to raise more than $10 billion from banks immediately and would take more than $1 billion in premiums out of the banking system annually. You want to expand your thoughts? And we've got about 1:40 to have the back and forth.
Okay, well, earlier I said the FDIC taking money from one business and giving it to another isn't a tax. Try not paying it, okay? It is a tax. It's mandatory. You don't get a choice. And so raising taxes always comes out of all the other things you might do, like, be able to, anyway, it's a cost that's imposed on the people who are investing in that bank.
Yes, sir.
Ultimately, they pay it.
Mr. Muser kind of asked you, and he ran out of time talking about, so what are the solutions? If this is not the right approach, Mr. Norquist, what would you propose if we gave you the pen, gave you the pad, and said, fix it, what would you do?
Well, first, I'd reduce some of the barriers that you have to allowing all of the various alternatives, which some people have poo-pooed here, but which are private sector voluntary agreements where the market says there are different ways to do this, both insurance. In my written testimony, there are examples from various states where they have done that. Massachusetts has set up a fund that's voluntary and has been operating since the 1930s. It doesn't have to be mandatory. It doesn't have to be the federal government. It doesn't have to be this big.
Yes, sir. And I just want to underscore, Mr. Chairman, that why this hearing is so important. You have different banks, different sizes, different regions, different asset and exposure allocations. So we need to be careful trying to come up with a one-size-fits-all, and perhaps whether it's a weighted or however we land this plane, but it's important, and I think it's an important conversation, and I respect and appreciate all of your opinions, but what I really wanted to do is emphasize that this is a very complex issue. You mentioned the S&L crisis. What they did back then didn't fix the problem. One would argue that it made it worse, and we have to be careful as we move forward. Thank you, Mr. Chairman. I yield back.
The gentleman yields. The gentlewoman from Texas, Ms. Dela Cruz, is now recognized for 5 minutes.
Thank you, Chairman, and thank you to the witnesses today. We're almost at the end of this hearing, and I greatly appreciate your time and sometimes repetitive responses, but it is important that each of our districts hears our clip of exactly how this affects them in their communities. I represent and have the honor of humbly representing Deep South Texas, where my area is largely rural, and so small community banks are the backbone of what helps us thrive. My district is largely Hispanic, where small businesses are important and where funding those first-time business owners like myself are very, very important. And I understand that this is such an important conversation. And as I've listened throughout the day to your thoughts and your responses, I can see that there is a diversity of suggestions, that some conflict and some not so much. This tells me that we need to keep talking about this, but more importantly, we need to find a solution immediately, because everybody is affected, from small banks to our large institutional banks. I'm pleased that all of you all are here, but my fellow Texan, Mr. Furlow, thank you for being with us today. We do know each other from having ongoing conversations when it comes to community lending. So I would like to bring the perspective of the banking industry from Texas to the national stage. Mr. Furlow, can you explain how a tag program or a deposit increase would have and could have helped during the 2023 SVB and Signature Bank failures?
Yes, ma'am. Our two-step proposal that we have with 6 other states is all about looking at 2023, dissecting that, and working our way through to ensure that we address those conditions that were taking place. In South Texas, as you mentioned, our community banks are absolutely an integral part of the lifeblood of the economy. And in 2023, when we had a systemic issue, through no fault of their own, our community banks were impacted. And our proposal about having TAG is to do 2 things. Number 1 is to ensure that there is a backstop that is in place today, that we can quickly implement in a non-bureaucratic way, so that banks of every size and wherever a depositor chooses to bank, that they are safe for a brief amount of time, so that we don't get into the issues of moral hazard. So that's number 1. That's the first step. The second step is to thoughtfully consider all of the issues that we've talked about today, to include where should the thresholds be, because we need to know and understand simple questions. Number 1, what are we trying to achieve through increasing thresholds? Number 2, who is going to pay? And number 3, how much? Those are all basic questions that need to be answered in all of these discussions, but as you've seen today, there's not agreement, there's not consensus. And if that is the case, it makes the argument for ensuring that we have a TAG program for emergencies, for systemic risk on the front end, while we can work through these issues and gain consensus.
So as a small business owner myself, I received my first business loan from a community bank, a community banker that knew me, Monica, the individual, and the integrity in which I was going to run my business, and thus repay the loan. So it sounds like, and I would like to acknowledge Ms. Castilla, congratulations, you go girl, for having your bank and being the leader, female-owned businesswoman, and that of a community bank. I applaud you for this effort and for your success. You've said over and over again how in these really trying moments, your bank held the line. And you did not have some of the effect that SVB banks and other small banks may have incurred during this troubling bank time. And so I am always protective of our community banks, because I know how they helped me personally and help other Hispanic small business owners in South Texas. So I will write my question to you, and I hope that you will answer. Thank you. I yield back.
The gentlewoman yields. The gentleman from Texas, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you. Thank you, Mr. Furlow, for being here. Great to see you. I have just a few brief questions for you. Mr. Furlow, does a one-size-fits-all increase in insurance coverage risk amplifying concentration at the largest institutions, rather than supporting relationship-based bankings in communities like those in South Texas and other banking deserts, if you will, across the state and across the country?
Congressman, that's what this discussion is all about. You know, as I consider what full-scale modernization should look like, if y'all are familiar a little bit with liquid dynamics and a tanker truck, They're essential. There's these baffles that stand in between, so you don't have slosh across the entire vehicle that makes it unstable. And so we need to look at how we approach the future of deposit insurance, and so many of them are here today, but we just don't know. But to ultimately answer your question, we need to ask what the future looks like. It's 1933. We've had discussion about technology and advancement of payments and these types of things. All of that needs to be considered. But in the meantime, we've got to have a backstop. Yeah. We can't have our community banks in South Texas, where you and Congresswoman Dela Cruz, their small businesses are so dependent on community banks. And in 2023, it was not fair that they didn't receive the same type of coverage, even though they paid premiums.
That's right. I'm especially concerned about community banks and regional banks. My next question is for Ms. Castilla. My concern is that even well-intentioned deposit insurance reforms could unintentionally harm people in banking deserts, as I mentioned, in places like that I represent and other places around the region. Working Americans who often have under $1,500 in their accounts. Rising assessment payments and compliance costs may push many smaller institutions to raise fees, cut services, or increase account minimums. A lot of it that's already happening. Effectively pricing out working class families already strained by policies like the Republican One Big Ugly Bill and recent funding bill that failed to extend the ACA tax credit, which will make health care unaffordable for nearly 130,000 South Texans. And when that happens, people don't stop needing financial services. They're turning to higher cost alternatives that aren't FDIC insured. The question is, what safeguards can we put in place to ensure that that deposit insurance reform does not increase costs for working families and underbank them and push them away from regulated banking system that's been so effective for so long?
This is a wonderful question. Thank you for answering. I met and married a South Texan, so I just have to give a shout out to
All right.
shout out to South Texas. He's in the room. But this is what I see every day. I sit in my lobby. I talk with our consumers and our businesses, small businesses, and it's about that trusted relationship. So I would just be so careful, and this is what I'm scared of, that we might do something that hijacks that relationship so that we're leaning on more the government for trust rather than that trusted relationship that a community banker can provide.
Great, thank you. And I'll have one question to the panel, and anyone can answer it. What are we doing to try to find ways, especially for community banks, to find ways to increase deposit coverage under when it's just one or two or a couple that are depositing and they want to deposit, $1 million or $2 million, and there's just not enough coverage? What ideas are out there to give banks cover and allow people to feel comfortable making larger deposits?
Yes, sir. I do this every day. So if someone has increased, if they have a deposit that's over the FDIC insured amount, our team, our tellers, our personal bankers know that we have tools available that we will proactively offer if they want to have full coverage. We do this with nonprofits, and we do it with less sophisticated small businesses and more sophisticated businesses. So there are tools in place in the marketplace that allow us to maximize deposit insurance so that we can make that, we're educating what deposit insurance is, because a lot of my customers don't even understand that exists, first of all, and then maximizing to really show the strength of the...
Folks who are making larger deposits do understand very well and are just diversifying through many banks, and I know some folks that, they bank with 10 local community banks in a small town because of the concern, but thank you for being here. Thank all of you. Thank the panel. This is a very important topic, and hope we continue working on it. Thank you.
The gentleman yields. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you all for being here. I know it's a long morning, now afternoon, but and I'm trying not to be redundant, but let me start with Mr. Furlow. I know there's been discussions about moral hazard before. Can you just, there's a relationship between creating moral hazard or weakening the kind of the market discipline, which is kind of what we were talking about. Is there, how do you keep kind of both of those in balance, would you say? Just to make banks and depositors prudent, right, in the way they make those decisions.
Yeah, and that's why this discussion that we're having over where the threshold should be is so important. Again, it's not agreed to. One of the things that we did when we made our tag proposal was address a concern that was expressed by those of you in the Congress. When we were in the middle of that crisis, we were asking for a tag-like capability. And we kept hearing over and over again, well, what about moral hazard? And so we have to design a system that is balanced. It has to address issues such as moral hazard. Where that needs to be, that's the discussion. And until that time, we need a backstop.
Very good. Mr. Norquist, I'm so glad to see that you're on the panel. Can you just talk a little bit about how the coverage that's created interacts kind of with a broader regulatory framework, and would increasing those insurance limits, it kind of focuses in on how the federal government is involved in the overall oversight. And I think there's a lot of us here today that are, you know, when you hear kind of that regulatory framework, it's overarching, right?
Banking is one of the most highly regulated industries we have, and it has periodic problems, which suggests that too much government doesn't fix everything. And now that we've pointed out some problems, people think more government would do the trick. I'm not sure that history looks kindly on that analysis. When we started with $2,500 guarantee, and then $5,000, and then
Right.
and now we're talking about $250,000 up to $10 million. Increasing those is not necessarily a good idea and raises real questions. And we've seen directly from the 100,000 jump up to 100,000 what that did to the savings and loan industry and why it allowed people to take risks that they shouldn't have, or invest in their friends' things, or to the local union stuff that they wanted. And they ended up ruining a lot of people's lives and creating tremendous damage because of the government guarantee, and implicit government guarantees also can cause problems. We need to be clear what the government isn't doing as well as what it threatens to do.
Very good, thank you. Mrs. Castilla, reciprocal deposits are a means by which a bank can insure at least a portion of the deposits in the customer's respective deposit accounts above the FDIC's insurance coverage limit. So, given your experience leading a community bank through challenging times, how do reciprocal deposit arrangements help smaller banks manage liquidity and serve business customers?
Yeah, so I used to sit with customers, and we would go through call reports to see where they could place their $250,000 around the community and have it safe. Reciprocal deposits allow us to have a technology platform where we can do this more automated, and that they can have one entry point with me to be able to access multiple banks. So they have this trusted relationship with their banker, and they're able to identify which banks they would like to exclude. The great thing, too, about the reciprocal network is it automatically freezes out 4 and 5 rated CAMELS rated banks. So troubled institutions can't go there to raise more funds. Going to the moral hazard issues, where if you have FDIC insurance, you could potentially have increasing exposures at troubled institutions and increase the exposure to the DIF if there's a failure. And so I'm able to use it. There's really not an amount that I can't handle, and I can one-way sell if I can't ingest all the deposits onto my own balance sheet. I can send that out just one way, so it's not reciprocal. It just goes one way out to the banking community, and then they're able to use that liquidity for their asset deployment.
Is there anything we should be doing that could help in your effort in the way that you handle those situations?
It's a great question, and I believe this committee, the reciprocal bill that came that actually allowed me to have more reciprocal access without it counting as broker deposits, it's exceptionally helpful, because this is organic deposits that I source that I'm able to feed into the system, and having that live to the broker deposit level, the 20% of my assets, was a huge help for me and other community banks.
Thank you so much. I yield back, Chairman.
The gentleman yields. I now recognize myself, the gentleman from Montana, for 5 minutes. Any reforms to deposit insurance should be well thought out and take into account a range of views, so I really appreciate that we're having this hearing here today. I represent Montana's 2nd Congressional District, which is the largest congressional district by landmass after Alaska. Now, banks in rural areas are some of the smallest in the country, but I am particularly concerned about their added costs in the long run with any potential reforms. And I'm going to start with Mr. Norquist. It's good to see you. It's been a while. Is there actually evidence that our current system and limit for deposit insurance coverage is insufficient for protecting customer deposits?
I don't think you can make that case. What you saw recently, some of the failures Silicon Valley, the people, the government guys who are supposed to be regulating it, saw the problem, highlighted it, and it wasn't acted on. It wasn't a question that there wasn't enough insurance.
Thank you. I'm going to move on to Mrs. Castilla. You know, one of the subjects of debate about deposit insurance is its costs. Most often, this is focused on the costs of increased assessments on banks, and some have advocated for a policy of exempting small banks from any special assessments needed to finance the deposit insurance fund to cover newly insured deposits if the limit is raised, but only for 10 years. So will such exemptions truly shield small banks like yours from the cost of increased assessments in the long term?
I don't believe so. And even there in the 10-year period, those are a lot of words to congest to see that I'm not going to get costs during that 10-year period. So I do think that if there's a failure or if it gets squeezed and we subsidize paid-in assessments to subsidize the costs associated with this increase, then effectively I'm paying for it.
So I assume a roughly $400 million community bank probably doesn't have a lot of customers with $10 million in their checking accounts, just assuming.
Sir, you would be correct. I have customers with that account, but I pay them interest. And so I make sure that they have their insurance and I pay them interest for that money.
Despite this 10-year exemption, how could smaller banks like yours still end up paying for someone else's lunch?
Yeah, so the way that I've seen this bill whenever someone's explained to me how it's going to be paid for is this buy now, pay later concept. So it also squeezes in that deposit insurance fund number very close to that 135. Well, you're using money that we've already paid in to be able to subsidize the cost of that. And you're also not fully realizing through this manipulation of funny math, be able to say this is truly the liabilities that were exposed. They're booking all of that insurance real time right from day one, but then paying for it for 10 years, which doesn't make a lot of sense to me. And so if there's a failure during that time frame, the DIF will not be able to handle that type of failure loss, and I will be exposed for a special assessment as well as other community banks.
Thank you. So as a small government conservative, I always prefer private market options over federal government solutions. So staying with you, Ms. Castilla, are there any other private market alternatives to federal deposit insurance coverage that have not been discussed today that Congress should take a look at?
The only thing that I would say is that there are multiple reciprocal networks, so there is competition in that space, and that's evolving even more so over the time. I get called on repeatedly for bank coalitions that are showing that there's ways to share our deposit coverage, to split our customer accounts to one another, and then bring out be able to reciprocate with other banks. So, and I'm sure that there are others that I don't know about.
Well, I thank all the witnesses for being here. I know it's been a long hearing so far, but we're getting to the end. And I yield my time now. And the gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses for being with us today. Now that operations have returned to normal, I'm pleased that the chairman and this committee are turning our attention to the future of deposit insurance and to the role the American taxpayer may need to play in maintaining confidence in the financial system of the United States. This is an issue that generates strong views in my district, and I regularly hear from constituents who view recent proposals both favorably as well as those who urge caution. For me, understanding the appropriate deposit insurance framework begins with having reliable and comprehensive data from financial institutions of every size. Only with accurate information can we form a clearer picture of the realities of today's financial landscape. As technology continues to evolve, we must use it to improve our understanding as Congress examines the programs administered by the FDIC. Ms. Castilla, based on your work, do you believe we currently have sufficient publicly available data to justify major changes to the deposit insurance framework?
No.
Simple enough. And if the data set is as incomplete as both you and I believe, what specific information should Congress require from regulators and financial institutions in order to properly assess both the nature of the problem and the potential effects of any proposed reforms?
Yeah, we really haven't seen good data even how deposits were flowing in and out to substantiate that this is even needed to be able to dig further into the data. So I think we first need to see, like, is there a problem, or are we just looking for the data for the solution? And so I think that really documenting what the problem is very important, and their data is available for that.
Thank you for that. Building on your response, I would like to turn to the question of whether Congress should move forward at this moment. On the surface, we know that approximately 99% of the 860 million depository accounts in the United States are fully insured under the current framework. That is a notable figure in today's financial environment. At the same time, The proposals before us should raise complex and nuanced issues. With the data set as limited as it currently is, we have raised concerns that changing the deposit insurance framework now could lead us to address problems that are not yet fully understood or could cause us to overlook vulnerabilities that the available data has not yet revealed. Mr. Norquist, based on the information available today, do you believe there is clear evidence of a systemic failure in the current deposit insurance structure, or are the concerns being raised more reflective of isolated events rather than a broader structural weakness?
Well, I think the argument for expanding it doesn't make sense. The argument for making sure that other alternatives, and this is discussed, both private insurance and the other mechanisms are important. And every time we tax one part of an industry, and this is now we're going into the business of taxing one set of businesses to subsidize another set, that ends up with all sorts of political problems, economic problems. There's no end to it. People who are left out of the chopping block in the first 10 years are right on the chopping block probably 5 years from now. I mean, this moving in the direction of more government subsidy and more government guarantees rather than trying to figure out what do we do to limit the cost of government inside this and government regulations. This is a wildly regulated industry, banks, and that causes some of the problems. We need to be looking through what don't the federal government and the states need to do in the regulatory costs that they impose.
We definitely need to streamline regulation at all levels. If the concerns we are seeing are primarily the result of isolated events rather than a systemic failure, what additional indicators or developments would you need to see before concluding that broader reforms to the deposit insurance framework are warranted? Mr. Norquist.
Well, I think there are arguments for reforming it by reducing the amount of cost that you put on people and allowing more, again, more private alternatives to this. We know that from the data today. We've seen when the amount of money that was covered went up, we had the S&L crisis that flew directly from fixing an earlier, assertion of an earlier problem. When the government gets more involved in something, it doesn't necessarily make it better and doesn't have a very good track record of handling that. And any industry that gets into bed with the federal government is going to find that this was not the place they wanted to be.
Thank you for that. Mr. Chairman, I yield back.
Gentleman yields back. Welcome the gentleman from New York, Mr. Garbarino, who's our chairman of the House Homeland Security Committee. Welcome. You've got 5 minutes.
Thank you, Chairman. Thank you all to the witnesses for being here today. A little out of breath, I had to run up the stairs. Should be in better shape. You don't have to run on a golf course. Deposit insurance is a vital component of our banking system. It provides security, peace of mind, and financial stability for Americans participating in our financial institutions, while also promoting stable liquidity for banks to provide additional credit to individuals and businesses. Conversations between legislators and relevant stakeholders have debated the merits of and feasibility of increasing the $250,000 deposit insurance coverage per depositor, including the Haggerty-Also-Brooks bill in the Senate that increases coverage threshold to $10 million. Mr. Ryan, can you give us some examples of the types of businesses that maintain a $10 million balance in an operating account?
Yes, I think the easiest examples to really understand is really some of our largest employers, and even a small town like Evansville, Indiana, would be our universities and our hospitals, who routinely have those types of balances in the multi-million-dollar category for payrolls and to buy supplies. And
2023 not only brought about the failure of SVB, but also of the New York-based Signature Bank. We all know SVB failed because of management and regulatory issues. Ms. Castilla, had the Haggerty-Also-Brooks bill or any other solutions we are considering today been in place, would Signature have remained solvent?
I don't feel equipped to be able to answer that question. I'm sorry. That's outside my area of expertise.
Is there anybody who would like to answer that question?
No, based on the regulatory post-mortem reports, one of the main reasons why Signature Bank failed was because of a mismatch in its on its balance sheet for long-term securities. So if there was an increase in coverage for deposit insurance, that more likely than not would not have saved the bank.
Thank you. And I know that there have been arguments made that deposit insurance legislation is meant to level the playing field. Mr. Furlow, by increasing the threshold to something like 10 million, are we overcorrecting, or is the jump from 250,000 to 10 million justified?
Well, back to 2023, the question at the time was, what should the number be? Should it be half a million? Should it be 2 million? But we were nowhere near $10 million. And what are the implications of that jump up to $10 million? I don't think we know. I don't think we have the complete data. Look, hey, I'm open to exploring what the number needs to be. And if it needs to be at that number, so be it. But we need to have some data. We need to know who's going to pay, how much they're going to pay. It can't just be that we bought the washing machine, we know we can pay for it over 10 years. It's like, okay, well, how much does a washing machine cost? And what do I have to pay every month for it? So we need to look at this. And again, we're very open to any range of ways to increase the threshold. We should look at indexing within the context of regulatory reform, right? That's another option that this committee can look at. But if we don't address the issue of being ready for a systemic crisis at any moment, this industry remains at risk, and we have been since 2023.
Is the data available? Like, I mean, you said is it there? We just haven't looked at it? I mean, or do we need to really?
Again, as this hearing has pointed out, as the Senate hearing pointed out, no.
Mr. Ryan, did you want to respond to that?
I would just add, this is not a theoretical conversation, right? This was a real crisis the country faced in 2023. So action is required here in order to not face another one. In the last 5 years, we faced 2 of these. And I would just recall Acting Chairman Hill's testimony in his confirmation hearing that he does not believe there is a substantial increase required for banks to pay for this increased insurance. So I assume he has lots of data. I assume he's a pretty sophisticated set of analysis behind him, and his own analysis suggests there's not a large increase in cost.
Yeah, I agree. I think there could be movement here, and the 10 million seems a lot.
I think we're missing a lot of data about what the problem is. And if the problem is a systemic issue that we need to rectify, then maybe a temporary tag order is in order versus having the insurance. But I think we're really missing the data as to pointing to what is the problem we're trying to solve.
All right, I appreciate all you being here today, and I thank you, Mr. Chairman, for allowing me to ask some questions, and I yield back.
Gentleman yields back. Chair recognizes the gentleman from New Jersey, Mr. Gottheimer. You're recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate it. Mr. Norquist, as you know, banks are required to pay premiums to the FDIC. In your recent op-ed, you pointed out that the FDIC would need to raise more than $10 billion from banks immediately and would take more than $1 billion from banks annually to fund the senator's proposed increased deposit insurance limit. How would this proposed policy change impact economic growth, and how do you see consumers being affected by banks paying more for premiums?
Well, any tax on any industry takes resources out of that, and this will hurt people who invest in banks and people who own banks and banks that are trying to make loans. It takes resources out of what they would be doing as bankers.
So it affect consumers, right? Obviously, get passed along.
Yes, it affects consumers for all the same reasons, yes. When you tax businesses, you tax consumers.
Ms. Castilla, since 2023, we haven't seen any bank failures of the same scale as we'd seen. However, we must continue to ensure the health of our banking system through effective oversight. We need to do everything we can to prevent another crisis, especially need to make sure that our community banks are healthy and thriving, in my opinion, as they're vital for local economies and local lending. What smart guardrails should Congress consider to be most effective in strengthening community banks like yours?
Well, so many of the efforts that this committee has already undertaken will help community banking, deregulating, allowing us to deploy more capital into our communities as loans, through lowering the community bank leverage ratio. Whenever we look at the Bank Secrecy Act and the requirements there to report, that's 3 full-time people and my team of 70 dedicated to that effort. There's so many ways that you all are taking this effort, whether it's reciprocal bill and ensuring that I can participate in the reciprocal market and not be penalized from a broker deposit standpoint, and then holding regulators accountable. If they should have seen the exposure and concentration of an SVB well ahead of time, and we could have averted that disaster if we would have had better regulatory oversight in that situation.
Have you seen it change? Do you think there's better regulatory oversight than there was a couple years ago?
I would say that my regulatory oversight has been consistent and strong in promoting the safety of my region. And that's been my experience. I'm a Federal Reserve and State Banking Department. I have an exceptional bank state commissioner who is deeply engaged with the health of his local community banks.
Do you find any conflict between the regulators that you have to deal with?
Yes, a conflict isn't bad. That's what this panel is about. It makes us all better. And so debating and making sure that we fully understand the risk at hand and how we're managing it is part of the oversight responsibility.
Thank you. Mr. Ryan, in the aftermath of 2008, the financial crisis, which had an outsized impact on the mid-sized regional banks, as you know, Congress passed Dodd-Frank, which enacted standards and oversight to help protect our financial system. Critical that we continue these steps to bolster our regional banks' resilience. After SVB's collapse in 2023, I advocated for additional oversight measures and a responsible increase to the deposit limit. If there was an increase to the deposit insurance limit and one that's reasonable, how would this impact regional banks' business practices?
I think it only goes to strengthen the resiliency and the diversity of our banking system, which is needed. We've seen banking, the number of banks since the financial crisis be cut in half. And I think level the playing field by having higher FDIC insurance limits for all of those that aren't implied to have unlimited guarantees, which is about 40% of our deposits are held by the GSIBs today. I think that only further strengthens the resiliency of our great American banking system.
And do you think the larger institutions obviously benefited at the time? Do you think that's still the case, where the larger ones continue to benefit?
I think there's common belief that there's an implied guarantee that these institutions, will be supported in the event of crisis or stress.
Right, and that's probably put even more stress on our regionals.
Correct.
Okay. Thanks, I yield back.
Thank you.
Gentleman yields back. Gentleman from North Carolina, Mr. Moore, you're recognized for 5 minutes.
Thank you, Mr. Chairman. For the past 90 years, deposit insurance has protected depositors and helped maintain public confidence in our financial system. But the bank failures in 2023 that have been referenced already today did reveal some new vulnerabilities in our system, largely driven by the speed at which deposits can now move. Nearly, I believe, $600 billion in deposits fled the system in a matter of weeks. And that level of volatility is certainly something that the original deposit insurance framework was never designed to handle. Mr. Furlow, I'll start with you. Technology has clearly changed the nature of bank runs and the stickiness of deposits. How should policymakers account for those changes as we consider potential reforms to the deposit insurance?
Congressman, thank you for the question. We need to make sure that we can move promptly whenever we see particularly systemic risk. You all saw what happened in 2023. Earlier in the conversation today, we talked about the potential for AI. What happens if there are nefarious actors who decide to utilize AI to attack our economy? So we have to have the ability to move quickly. Again, why we're proposing this two-step process with an emergency tag capability to put stability into the system immediately should we have some downturn.
I believe right now roughly 99%, I believe, is the statistic that I'm aware of all U.S. deposit accounts hold less than the $250,000, well within the FDIC coverage limits. But what kinds of businesses, and this may have been touched on earlier, but what kinds of businesses and other account holders typically hold balances above the statutory insurance limit? Mr. Ryan, if you will take that.
The greatest example I can come up with, which tend to be some of our greatest employers, especially in Indiana and rural parts of Indiana, are the hospital systems and the university systems. I mean, they routinely have multiple millions of dollars sitting in their account to handle payrolls that happens and obviously supplies that are needed to buy. So this isn't a theoretical argument. This is real large employers who are vital to our communities who need this type of coverage.
And then let me ask you this, same follow-up on that, Mr. Ryan. I know that reciprocal deposits have given community and mid-sized banks a tool to insure a portion of the deposits above the FDIC's $250,000 insurance coverage limit. So how have the reciprocal deposit networks helped level the playing field for smaller and regional banks?
I do think it is a tool. Less than 1% of our clients choose to use that tool. It adds complexity and cost, somewhere around 12 to 15 basis points, to seek that higher coverage out. But I will say it works during normal periods of time. It's not perfect, and most businesses don't appreciate the complexity of have to have multiple relationships, multiple sets of accounts at these organizations. And the last thing I would in times of stress or times of crisis, it's really hard to explain how these reciprocal networks work. And I think to the extent we keep pushing deposits towards these reciprocal networks, I think we're concentrating risk in sets of entities and organizations that we just don't know what's going to happen in a time of crisis.
And the key is to talk about these programs not in times of crisis. It should be part of everyday discussions with our customers as their trusted advisor.
Agreed. Let me ask you this question, Ms. Castilla. What would be the real-world impact, if you will, of expanding, say, coverage for business accounts, but not for individuals?
So this is on non-interest-bearing accounts, and so you're immediately shifting a business from likely being an interest-bearing account with reciprocal deposits, which our customers do not mind that there is some complexity there, to now not earning any interest on their account, and they have $10 million plus in that account. Mechanically, it doesn't really work any different. They have the same amount of coverage. They're just not earning interest. The bank is saving money because they're not having to pay the network the 12.5 basis points.
Very good. And Mr. Norquist, I have to ask you a question. It's been a while. I'm still getting used to seeing you without a beard. Every time I just, but it's good to see you, sir, and appreciate your longstanding friendship. But I do have a question for you as well, and that is,
Sure.
You have advocated against raising insurance limits at all. And from your perspective, what regulatory or supervisory reforms should be prioritized first before considering changing deposit insurance levels?
Well, in the case of Silicon Valley, the regulators did highlight things, but nothing was done there. So the failure was internal. The government had the information, didn't act, and you had the failure. I would go through the regulations that have been put on most recently to frankly look at which ones ought to be taken off. Talk to all the various sized businesses. There's been some effort in 2018 to do some of that, that made some real progress. We've been larding up the regulations on the banking industry for a long time.
Gentleman's time has expired.
Thank you. And I just want to say thank you. This is a great panel here today, all of these folks. Without a yield back, Mr. Chairman.
Thank you, Mr. Moore. I want to thank our witnesses for their expertise, their great communication skills with all of our member engagement. I want to appreciate your testimony and sharing your time with us today. Without objections, all members will have 5 legislative days to submit additional written questions for the witnesses to the chair. Questions will be forwarded to the witnesses for their response. And witnesses, please respond no later than December 23rd, Merry Christmas, 2025. This hearing is adjourned.